I think mostly it must be related to your current business,
Yeah, because
right?
we are still in transitioning from that, what is it, traditional enterprise risk management to project risks and investment risks.
Yeah.
So this is why
So that
there.
is what later on in your careers, when once you keep on doing CFA, you'll realize that later on, right now, whenever
I
we
think
are looking at
mostly it must be related.
investments, right?
Hmm,
We are usually thinking that investments only in the form of stocks
correct.
or investment per se, let's say uh, bond, right?
Hmm, hmm,
But
hmm, hmm.
later on, what we realize is there's actually no difference when we are managing a business also.
Correct.
It's the same thing, right? So at least that is what my realization has been, that this is the same thing, whether it's stock, whether it's business, it doesn't really matter.
Hmm,
At the end of the day, it's a activity which generates returns.
hmm.
And hence, whichever methodology we learn in CFA on managing such investments, the same principles we also use it for business, right?
Yes, yes,
So
yes.
that's the beauty of CFA. I mean, uh, hopefully we complete it
This
on
was like,
time.
not very much planned in my schedule for the year. But somehow,
CFA?
no, no, this one, this investment appraisal. CFA was like, I have been planning for this since 2021.
Acha, 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 okay.
Happened, I got lazy, all that, blah, blah, blah. This year I thought, I'll pay the fees, I'll
Huh.
attend the class, I'll pay for the
Yeah,
exam.
that's the best
Then
way
only
of
it will
doing
come.
it.
Yeah.
That's the best way of doing it, is to get yourself registered. That's what even I did when I was registering. Especially level one was not a challenge for me to register, because that time I was in my final year of my graduation and I had no option because all of my friends had already gone for MBA
Hmm.
prep. So I had to take a call. So the level one was not a difficult thing to register. Level two was a challenge because level one, I had got my results in January. I mean, December,
Hmm.
I gave the exam. January, I got the result. So I had just had 5 months to prepare.
Oh,
So that was difficult call, because level one, at least the older syllabus, level one to level two jump was very high. And I'm sure this time in the current syllabus also, level one to level two jump will be pretty big. Level three, again, after level two, I took a break of 1 year.
okay.
So that was a mistake. So because you take a break and then again,
Yeah, you need
remembering
to
things,
build
and
that
that
momentum again, right?
very difficult, right? But anyways, but it worked. I mean,
Uh,
once you have paid the fee. So in all the cases, what I always used to do is, just pay the fees. Finished.
yeah. Now, like, there was no escape. I paid the fees.
Yeah, exactly.
Honestly, if I would have known about CFA
Uh,
back in like 2015, 2016, I would have done that time itself. I got very late to know about this one.
right.
Only after like I came here in UAE, I just got to know like, there is a course like CFA, and that is very much in demand in the market, and it's very relevant to the profession where I am at.
Right.
But yeah.
See, one qualification in everybody's life is important.
Hmm.
One genuine, recognized, difficult qualification, and that's enough. Okay, so today we speak about one part of the content of balance sheet was remaining, which is financial instruments. Okay, so
Yes.
let's briefly discuss this. I didn't see much, calculations. You would not expect much of calculations on this topic, because it just speaks about the disclosures. uh, in the older syllabus, it used to also tell you to calculate. Okay, but we will still see some examples so that we understand what
Hmm.
we mean, right? So a company can buy, you know, investments, right? It can buy bonds, it can buy equities, it can buy, any form of liquid assets it can buy. So, according to the intent of the company and also its core business, we can broadly classify the any of the assets, financial assets, in three basic areas. Okay. So one is, we can put it as held for maturity. Okay. This is not any terminology. It is just understand that what is the intent behind any of these assets. So held to maturity, the intent is to hold it. Okay. Hold it for long. I mean, the idea is not to sell it off. Okay. So any equity stocks bought for the longer run, for capital appreciation for the stock to increase in value in the longer run would be classified as held for maturity. Then there is one more categorization which is called as held for sale. So this is possible. You can call it as possible to sell within the next year. Okay, so next year or in the immediate future, there is a possibility of selling this uh, asset. And finally, we talk about held for trading. So this is, as the name suggests, directly for gains. Okay. So usually a business will not put it held for trading unless its core business itself is trading or asset management. Okay. So an AMC might classify an asset. Okay. Or a brokerage company might classify an asset as held for trading because that is the core business. But let's say Apple would not classify stocks as held for trading because it would create a lot of volatility in their financial statements. Okay. So obviously there are regulations to this, but let's briefly understand without US GAAP, IFRS differences on how it affects the three financial statements.
So when you mention this, held for trading and asset management,
Yeah.
so what kind of instruments we talk about when we say?
Any liquid assets,
Okay.
for example, bonds, debentures, you can talk about short-term bonds, government bonds. You can also corporate bonds in terms of the classification of type of issuer. Yeah, we could also talk about equity. Equity can be many listed stock, unlisted stock, right? There could also be other forms of assets like, for example, gold ETFs, which are bought, right? So all of that financial instruments, right? That's a financial instruments. I mean, includes everything. For example, anything which is there in our syllabus of CFA, equity, bonds, etc., would classify under that, right? So now, first, let's do one thing. Let's create a very simple income statement, balance sheet, and cash flow. Okay. So if it is held for maturity, which is, I will just write it as HTM. Okay. Or let's say also write held for sale and held for trading. Okay. So how will this affect our three financial statements? Let's understand. Where will it affect? Okay. So if it is held for maturity and it is a equity, let's say it's a stock, then of course there is no effect on the income statement in case of held to maturity because stocks generally will only get dividends, right? But any price fluctuations, any which ways we are saying that it is held for long. Hence, in the balance sheet, it will be at cost. Cost in the sense, whatever my acquisition price of the stock was, it will stay. For example, you bought TCS at, let's say, 100 rupees, it stays at 100 rupees. Okay. Now, also in the future, until and unless I go and sell. Okay. Until and unless I go and sell the asset, that's when the gain will come in case of held to maturity classification. But again, usually the actual practical practice is that if a company wants to sell that security, first it will classify it as held for sale. So it will convert the security from HTM to held for sale and then execute the uh, sale of the security, right? So if let's, for example, say that we bought TCS in 2019 at 100 rupees. Okay. Now, let's say after 2024, right, the stock has become 120. So, in the balance sheet, the value is still 100. Okay. And in the income statement, there is no effect unless and until I'm going and selling the security. Is this understood? So usually this classification is much more, prominent in case of bonds, because bonds have some effect. Okay. So because bonds have interest and it also has value, right? So in case of bonds, again, bonds will be listed at cost, but interest would come in the income statement as an income. Okay. Now, this is one extreme. Okay. This is one extreme classification. And this is another extreme of classification. So let's go down. So in case of held for maturity, we are saying no effect, zero. In income statement, no effect. In held for trading, we are saying all effect. So because bonds also change in their value. How? So let's say this is your value and this is your interest rate, right? So bonds usually have a, so I'll obviously you'll learn this in fixed income, but if you want to simply understand, bonds value is defined by the formula present value. So present value is future value divided by 1 plus r raised to n. So what is future value in case of bonds is all the interest that you're going to get, right? So if let's say all the coupons interest that you're going to get from the company is in a future date, and if let's say the current interest rate increases, if the current rate increases, your bond value decreases. So basically, when the interest rates are increasing, right? If you're increasing, so your bond value is going down. So it's there as an inverse correlation you can clearly see here. So bonds, it doesn't mean that this, it's don't confuse thinking that it's like stock. No, I'm not talking like stock. It has nothing to do with it. Okay. Bonds, whenever value of a bond, value in the sense price of a bond, okay, is inversely related to interest rate, general interest rate. So if the RBI comes and increases the rate, price of the bond in the market will reduce. It doesn't mean the bond has become very cheap. Okay. All it means is because of this correlation which is happening. So now, if you are purchasing a bond, right? So if you are purchasing a bond in the income statement, balance sheet, and let's say cash flow also, right? You are getting effects. So if you listed the bond in the balance sheet as 100 and tomorrow, let's say this is 2020 and 2021, the interest rates have gone up. So the bond value will go down. So this effect is what we are talking about in terms of the classification. So if this happens, then in case of held for sale or let's say held for maturity and held for trading, what will be the effect is what we are saying, right? So in case of held for trading, this minus 100 will have to be shown in income statement as loss. But obviously you will mention it as unrealized. Please understand the term unrealized. Why unrealized? Because we have not really sold, we have not received the cash. But you will have to show this effect. So this will indirectly affect your net income, right? In case of held for maturity, since you will not change the value even if it happens. So you will still show 100. So in case of income statement, there is zero effect, right? So the bond value doesn't affect my EPS. So that's the reason why probably nobody will classify it as held for trading unless that is your main business, right? So, and held for sale, what would you do? Now, the question is an interesting question is, if that is one extreme held for trading and for held for maturity, then what happens in case of held for sale? So in held for sale, the only difference is that you would still classify it as unrealized losses and gains, but what happens in the balance sheet is interesting. Okay. So let's see what happens in the balance sheet. Okay. So let me create a balance sheet. So balance sheet, and let's say assets, liability, equity. Okay. And out here, we're talking about income statement. So in case of held for held for trading, so in the income statement, or maybe I'll draw the income statement here itself. Okay. In case of held for trading, I would show minus 100 as unrealized gains or losses. Okay. Of course, we understand that if we are showing this in the income statement, then this would affect my equity. So unrealized gains and losses in the equity. And the assets, since it is shown as fair value, right? So here the asset price goes down. So that's how the balance sheet actually tallies. Okay. That is held for trading. Held for sale, just a very slight difference actually, not much, but instead of unrealized gains and losses, you would classify this is held for trading. Held for sale, you will just classify a little differently and say it is other comprehensive income. Okay. In the equity below retained earning, you would show it as other comprehensive income. It's just a name. Okay. There's nothing more meaning to this. And of course, the asset value will be shown against the kind of losses that has been made, right? Held for maturity would be shown at cost, so no effect, right? Here also there will be no effect except interest. If there is interest, of course, in all the cases, interest will be shown. Okay, interest is shown in all the cases. There's no difference. So for now, you just need to understand in this classification is uh, that there are three kind of classification. Okay, and how it affects the three financial statements. Okay, let me see if I can show you an example. Yeah, so we have an example here. Okay, so I'll just copy this. Let me show this, okay? So here there is an example in page number, if you want to open it up, 101 of the curriculum. Okay. 101 of the curriculum, there is a example given, and I'll just write the details of that. So there's an entity here which has invested. So they've done an investment of euro 100 million. Okay. And this is in January of, let's say, 2002X. In a fixed income security, so this is a bond, okay, with a 5% coupon. So what is the coupon? Basically, coupon is nothing but the interest that you get regularly. This is not like a loan. You're just getting 5% of 100 million. So what is the coupon? It is written as 5% paid semi-annually. Okay, so that means if you want to calculate the absolute amount, this is basically 5% divided by 2 because semi-annual. Annual is 5%. So always interest rates are shown as annual. Okay. But usually coupons are paid semi-annual. So how would you calculate 5% divided by 2 multiplied by 100 million would actually give you the actual coupon. Okay. After 6 months, the company receives the first coupon. So the actual coupon that they receive is euro 2.5 million. Additionally, now here is the kicker that comes in, is that the market rates have declined such that the value of the fixed income has increased by 2 million. So interest rates have reduced. And hence the bond value is no more 100 million. It is 102 million. So because of it, there is a gain in the value of security. Okay, plus 2 million. Okay. And this is in 30th June. So 6 months. Now we need to understand how this will affect the three financial statements. Is this question clear? Let me know.
Yes, sir.
Question is clear, no? Okay. So now we want to understand practically how these three categorization, held for trading, held for maturity, held for sale, will show different effects in the three financial statements. Okay. So again, income statement, okay, balance sheet. So in case of at cost or held for maturity, in the balance sheet, okay, in the balance sheet, the cost of security would still be shown as, the bond will still be shown as 100 million. Sorry, this is euro. Okay, no difference. But even if the interest rates have gone up, down, it doesn't matter. Held for maturity means held for maturity. There's no effect. But in the income statement, we have still received the 2.5 million, haven't we? So that would be plus 2.5 million, right? And in the balance sheet, since you have received that, okay, how will this affect in terms of the assets? So your cash would increase by plus 2.5 because we have not been mentioned here whether it is accrued interest. It is just said that, you've got the coupon. Okay. So the cash would increase. And at the same time, in the balance sheet, the retained earning side would also increase by 2.5. Why? Because your net income has also increased by 2.5 out here. Right? So this is a very simple, of course, in terms of the effect in case of held for maturity. What happens in case of held for trading? Or we can say first held for sale. So in case of held for sale, again, do you think there should be any difference in case of interest income recognition? Interest income is interest income, right? So whether any classification you do, it will still be recognized in the income statement. It will still have the effect on the cash, which is plus 2.5. Okay. The cost of the security, okay, the cost of the security is shown as 100 million, and wait for it. But now the question is, what will happen in case of your held for trading? So in your held for trading, again, interest is same, 2.5 million. Unrealized gains and losses. Now here, this is where the difference lies. Out here in held for trading, you would say unrealized, which is how much? 2 million,
2 million.
right? And I don't know why they have not mentioned. Yeah, they have mentioned it here. That is what I was thinking. Why have they not mentioned other comprehensives? So if you are showing unrealized gains of value of security increasing, you also need to show in the balance sheet the equity side as other comprehensive income. I suppose they have shown it as other comprehensive income in case of, exactly. So in case of held for sale, they have to show it as plus 2 million as OCI. This is the short form of it, OCI. Okay, other comprehensive income. But in case of held for trading, we are directly just taking the entire gain in the income statement because you are showing it as gains. So your retained earnings would increase by 2 million. Your interest would also increase, which was how much? 2.5 million, right? And finally, your paid in capital is okay. I mean, that is the initial assumptions, but this is what the effect is. Now, one small difference between US GAAP and IFRS is what I wanted to show you, but it's okay. Okay. I think that is enough. Okay. Okay. So just please understand the difference between held for sale and held for trading because there is a very thin line. It's actually the same, only it's just the categorization is different. In case of held for sale, you are categorizing as other comprehensive income. In case of held for trading, you are not showing, you're just taking it at a profit and showing it in your retained earnings. This is a very thin line that you need to understand. Held for maturity is very simple, no effect. Only difference is held for sale and held for trading. Okay. We can further, try to simplify this by understanding the linkages between the financial statements. So remember when we were talking about when we capitalize something, when we were talking about how in case of capitalization or when we are buying equipment, it first goes to the balance sheet and then we get amortized. The same is actually happening in case of available for sale, because if you see what has happened is we have directly affected the OCI because it is shown net of PAT, right? And it is directly going in the balance sheet and is showing as accumulated other comprehensive income. So in reality, how it is shown is that it is actually shown as net income. Let's say it is 100, and then it shows as OCI of plus 2.2 million, right? So it is shown net of PAT. Okay, just to keep the PAT very clean. So after this, it is going into the balance sheet. Whereas in case of held for trading, it is directly inside this only. This is the major difference. That's it. If you have to understand something out of this, it is that in case of held for sale, net of PAT, and then balance sheet. In case of held for trading, in the income itself, directly affecting retained earnings. Any questions here? No.
This one is a bit tricky. If you can just
Yeah, it
go
is
up to
tricky. It
the,
is
yeah,
tricky. It is tricky.
just go up in the table. I just wanted to see like what exactly the entries are in the income statement.
Okay, so let's do one thing. Let's do that question itself.
Hmm.
Okay. Can you guys open up page 101 at your end?
Yes.
Okay. Now don't look at the solution because then you will obviously do the calculation. What I will do is I'll just, if you want, I can give you the text part only. Okay. Take this question. Okay. Now try to draw theme statements, income statement, balance sheet, cash flow. Okay. In fact, initially don't even draw held for maturity because it's very simple. First, write down all the values. Okay, start with always writing the values, which is what is the value of the security when bought. Okay. So bond value is, just write down like this. Bond value is euro 100 million. Okay. So whenever these questions come, you have to just these kind of concepts comes. If it is not uh, understandable theoretically, you just do a calculation and you'll understand. Okay. And what is the coupon? Or just don't even write coupon, just write interest as plus 2.5. I suppose it is 2.5.
5% paid semi-annually, right?
2.5, 2.5 million. I'm saying
Oh,
0.5 million, which is comes up to 2.5 million only, no? Because 5% divided by 2 multiplied by 100 million would come as 2.5 million as interest. Okay. And this is the initial bond value, the initial bond value, and this is the later bond value, which is how much? Suppose 102 million, right? Yeah. So 102 million. So this is actually the data that we have. Now, very simplistic if you want to look at the data, and now create income statement and balance sheet, basically. So let's write held for first. If you want, just do the easier one, which is the obvious one, held for trading. Now we have, let's say, revenues minus expenses is net income, right? So in case of held for trading, we are saying we're going to take all the gains. So plus interest is obvious. We'll show it plus how much? 2.5. What is the gain in security or profit? Unrealized profit. You can just write it that UR unrealized profit is 2 million. So your net income is how much? Gone up by 4 million. Now balance sheet. Now write down. What is the balance sheet? We have got assets, we've got liability, we've got equity, right? So in case of held for trading, what we are saying is, since this is already affecting the net income, what will it affect here? Retained earnings will be up by plus 4.5 million, right? An asset, you will show it at fair value. What is the value of the asset?
1 million,
It is
100 million.
102, right? 102 million.
102 is like after 6 months, right?
Yeah. 6 months, everything is 6 months, right? And see, if you want to see, this is the, if you want to see the complete effect, this will increase by 2 million, but you also got cash, right? This is the bond, right? And
Hmm.
the coupon you got, no? Interest. 2.5 is the interest, right? So you can see basically 4.5 million effect on the asset side, 4.5 million effect in the equity side, the balance sheet tallies. Is this understood?
The entries of this 2 million is what?
Sorry?
We, that profit that we are mentioning, right?
Uh-huh.
You see,
Uh-huh.
so interest is okay, understood.
Interest and different,
Just
no?
two,
Because in the income statement,
yeah.
if you see here, so I'll just use it if you want. So this is your interest,
Hmm. So that
right?
is okay.
And this is
2.5.
your unrealized profit. See,
Okay.
right? So 4.5 is the total effect,
Hmm.
and that affects your retained earning by 4.5. So this 4.5 is basically this 4.5,
Hmm. Okay.
right?
In the equity side. Okay.
In the equity side. But it has to balance. So
Hmm.
on the asset side, how is it affecting? So your bond value has increased, right? It was 100, it is 2. So 2 million effect out here is shown here,
102. Okay.
right? And your interest part is shown in the cash,
Okay.
right? If let's say it was, let's say the interest was not paid in cash and it was accrued, then it would be shown as accrued interest. It's an asset, right? Interest receivable or interest accrued. Generally, we don't say interest receivable, it is interest accrued, accrued
So
interest.
there is no entry in the equity part here, right?
There is no here for 4.5 million effect, the total effect, no?
Total is
See, the net income increased by how much? 4.5 because of
4.5.
interest and profit.
Hmm.
And then in the retained earnings side, it increased by 4.5, no?
Okay. Got it. Got it. Got it.
Right? Net income is related to equity,
So that in the income statement, the top part in the income statement, we are saying that unrealized profit.
unrealized profit. Yeah, because it is not realized, no?
So this is part of what? Revenue or?
Yeah, I mean, income, it is not part of revenue. It will be in terms of other income.
Okay.
So you will
Okay.
have revenue, then you have, expenses, and then at the later part, wherever you have interest, you also have other income. So this is a part of other income, right?
Okay.
This is held for trading.
Hmm.
So you can see that it is very volatile because as the asset will keep on increasing, decreasing, it will have an effect on your statements.
Hmm.
Might make your, see, you can see, no, right now it is looking good because there is a gain. But if
Hmm.
there's a loss, then your EPS goes down. Might not be very, I mean, the investors might not be very happy to look at that, right?
Hmm.
So now if let's come to held for sale. Usually companies will do this. Now, interest is same, whether any of the classification interest effect is same. So what is the interest effect? Again, same. So interest is how much? Plus 2.5 million, right? Now, what is held for sale doing is it is impacting the profit and loss, but how it is impacting the profit loss, I'll show you. Okay. So it is not showing unrealized profit just like your held for trading. On the left hand side, if you see 2.2 million, here we are not showing that. Understood?
But how come here interest is 2 million?
Sorry, 2.5. Wait,
2.5. Right? Okay.
2.5.
Okay.
Okay. So, but the unrealized profit, we are not showing.
Hmm.
Okay. So your net income is saved. Okay. But now see that now you can understand this also in a different way by understanding that, how the value of the asset gets shown in the balance sheet. Okay. So now see this, although you are not showing in the net income, okay, but in your asset side, the value of the asset still has to be shown, right?
Hmm.
So now in the asset side, if you just draw this, okay, I'll just take the numbers from here. Okay. Okay. So now in the balance sheet, what you're doing is, now please understand it from the entries only. Okay. So from asset side, bond side, okay, my cost of security is what? At which I bought, which was
100
plus,
million. 100 million.
right? Now out here, what we are saying is we are going to show it as unrealized gains
Yes.
of plus 2 million in the balance sheet. Now look at the problem here. So it is still 102 million, right? But see, in case of held for trading, what happened? We just increase the value of the asset only, right? But
Hmm.
in case of held for sale, we are putting another section and we're saying unrealized gain. Now the challenge is, okay, I'm not taking care of the interest part. I'll do the interest part also, but let's for deal with the value of the asset only. Okay. One equity, what do I do? Because equity was supposed to increase through net income, right?
Hmm.
But now I did not take the unrealized gain profit only here. So how will it affect my
Hmm.
equity? So that is why there is a section. So your retained earning has no effect, but there is a different effect, which is a term, which is what we were talking about, is accumulated other comprehensive income. So that is where what we are saying is we're going to show that income, whichever is how much? 2 million plus 2 million out here. Okay. So this 2 million is directly coming into the balance sheet on the equity side instead of first going to net income and then coming out here. In fact, in reality, in the financial statements, this 2 million is actually shown after net income below that as a separate line item, showing that this is the other comprehensive income, and then that comes into the balance sheet. Out here, how it is shown is a little more crude way, but in reality, in any income statement, it will be shown below net income as a separate entry. Okay, it does not affect the calculation. It is just for the purpose of your understanding. Okay, so now balance it. Okay, so the unrealized gains part is balanced, right? 2 million, 2 million.
Yes.
But now the interest part, how will it come? The interest will increase the equity plus 2.5, and it will increase the cash plus 2.5. So now what I want you to understand is just now notice the difference between held for trading and held for sale. The only difference is it is not affecting in the income statement. It is directly jumping and going into the balance sheet as other comprehensive income. Understood? So,
Okay. Okay. Now clear.
right? And held for maturity is nothing, no effect. Only interest effect is there. Okay. We will, just as a note, please understand, because next chapter is cash flow statement. So I just want to do a simple linkages so that later on we don't have to come back to this example. So now when we are creating the cash flow, okay, let's say obviously we start with net income, right? So we start with net income as some X values. Now understand that now this net income, this unrealized gain in case of trading 2 million, is it a cash revenue? Unrealized profit.
No, it's not a cash revenue.
Correct, correct. So that is why in the adjustments part, just remember that we had this discussion. Since it is not a cash effect, we will have to reduce that minus 2 million of unrealized profit from securities. Understood? Because this is one of the, it is very difficult to understand at that time when we will look at this example, because that time this relation will not come. That's why I'm making you understand this, that this is the example to remember whenever we are talking about adjustments. These kind of profits can also be related to gain, let's say unrealized gain in stocks, or let's say gain from sale of securities, right? Or so that kind of adjustments ke liye just remember this as an example. Okay, that we will have to adjust the net income for such adjustments. That time it will be very difficult to make you understand that. Okay.
Can you just spend 5 more minutes to give the, like, no, I still need clarity on sign of whatever values we are putting in the cash flow, like what should be negative, what should be
Yeah.
positive.
So cash flow statement is anyway next chapter. Okay. It is
Okay,
very detailed chapter.
good.
So you don't have to worry about that.
So I was just
In fact,
practicing
cash
that
flow statement,
worksheet.
for cash flow statement, we have already created a very nice background since
Hmm.
we did that sheet. Today you will understand why that sheet was important.
I was just practicing that in the morning, and I got confused again, so that's why I asked.
It's okay. I mean, see, you will get the hang of it once you look at more examples.
Okay.
And that
Okay.
is why cash flow statement actually has two chapters. One
Hmm.
is cash flow statement one and cash flow statement two. Cash flow statement one is all about the same thing that we did, but here we will understand it with more examples. Okay, now, anything out here? Okay, so I'll briefly explain you the, now look at the next, if you want to understand what is the next requirement in this chapter, it talks about disclosures related to non-current liabilities. Okay. So what are non-current liabilities? Non-current liabilities are long-term debt. Generally, whenever we are referring, we're talking about either long-term debt or deferred tax liability. Okay. So it is talking about disclosures. That means as an investor, when I am looking at the annual report, what extra information the company should disclose related to these assets or liabilities, right? So before this, we were talking about disclosures related to financial instruments. Now we are discussing disclosures related to non-current liabilities. Okay. So let me give you some important points out here. Okay. Now, here what you need to understand is again, a lot of the bond terminologies you will understand when you learn fixed income, but I'll still give you a brief idea of the problem that happens when we are, dealing with bonds. Okay. So I don't know how many of you have, I mean, whether you guys have purchased ever a bond or not. Okay. So bond, who is the issuer? The issuer is the company, right? So company is the issuer. Usually, whenever you discuss bonds, you have to make it clear whether we are talking from the issuer perspective or investor perspective. Okay, so right now we're talking about issuer perspective. The company is raising money through bonds. Okay, now whenever the bond is issued, okay, there are three terminologies which comes. But before the terminology, let me give you the example itself. So let's say the company is issuing a bond for 10 years. Okay, so let's say there are 10-year maturity bond. This is I'm just giving the details. The par value means just like a fixed value of a bond. Okay, just like how we say book value of stock, 2 rupees. That's the same way in bond also, the par value is, let's say, 100. Okay, that should ideally be the issue price. Okay, that should ideally be at which investors can purchase the bond at 100 rupees. Okay, I'll tell you the complication that happens. And then you've got the coupon, which is the interest rate that the investor gets. Let's say that is 5% or 6% semi-annual. Okay. Now the company is preparing to issue the bond, and the interest rates, let's say the market interest rates, is also 5%. Okay. So if the market interest rates are also same and the coupon rate is also same, then the present value of the bond will automatically come at 100. But never is that actual situation can actually happen. Why? There can be hundreds of reasons. First of all, if let's say it's a smaller company, if it's a small company, if in the market also I'm going to get 5%. When I'm saying market, what do I mean? This is government bonds. Okay. So RBI bonds, for example, right? Federal bonds, 10 years, treasury bonds. So if the treasury bond is also giving me the same rate, you are also giving me the same rate, then why should I, invest with you? So obviously the company will have to entice the customer with higher interest rates, right?
Hmm.
That is when the mismatch will happen. Okay. So if let's say the government bond interest rate is 5% and the issuer rate is, let's say, 7%, what will happen? The present value will go down, the bond. Remember, I said the bond value is inversely correlated to the bond value because of the present value formula. Because what it
Understood.
does is, for example, this is the cash flow 0, 1, 2, 3. I'm teaching you a little bit of fixed income here. So let's say we are getting 5 rupees, 5 rupees, 5 rupees, 5 rupees. Okay, in periods, various periods. Now, what is the present value of the bond? It is the present value of all these cash flows brought to zero. Okay. Present value means that I want to understand whatever I'm going to get at year 4, what is its value today? So how will I calculate 5 divided by 1 plus market rates or your issuer rate of 7% raised to 5 plus 5 divided by 1 plus 7% raised to, let's say, 3, sorry, 4, right? And so on. So if your denominator in this formula, which is future value divided by 1 plus r raised to n, if your denominator increases, then your present value
decreases.
So this is the reason why the bond value changes. Okay. So now if you issuer rate was 7%, then of course, what will be the bond's initial value? The value will be less than 100, right? So that is called as bonds issued at discount. It doesn't mean the same discount that we talk about in our general terminologies. Okay. Don't mistake it.
So basically, like when you have mentioned here market interest rate, government bonds, you are just comparing the issuer's return with market and government bonds, right?
Of course, because see, even with equity,
Hmm.
not just bonds, okay, even with equity, I'll just tell you how the present value rate is calculated. The rate, right? The discounting rate we say, no. How do I calculate the present value of something? It is not always inflation. Okay, inflation is one part because see today whenever we are saying returns, what is my expectation? It is through a formula, which is risk-free rate plus beta. This is equity part, but I'm still telling you RM minus RF. This is also called as the capital asset pricing model.
Hmm.
Okay.
CPM.
So, yeah. So now whenever we are finding the present value of something, at least in terms of equity, what are we saying? This is government bond rate. So we are saying when I'm expecting a certain return, obviously I want more than what the government bond is already giving. Government bond is giving me without any hassles, let's say 7%, right? So I'm going to expect more than what government bond is giving, right? So then I'm calculating beta of the company and I'm saying that, okay, what is the risk of the company? Are you more risky than Nifty 50?
Hmm.
So if you are more riskier than Nifty 50, then your beta will be higher than 1, right? What is the general returns on Nifty 50? Then you say 15%. Okay, fine.
Hmm.
That means I am expecting what is the premium that you're giving me? Because 15% the equity markets are giving,
Hmm.
7% government bonds are giving. So I want 1.2 times of the difference, right? So now when you calculate this, your expectation becomes 15 minus 7 is 8, 8 into 1, let's say 9.6, right?
Hmm.
So that becomes 16.6% is my expected return.
Expected.
Doesn't mean that we'll get it.
So this RM minus RF is here what? Like RM is the return
Premium.
of the market.
Return on market, which is Nifty 50, any benchmark.
Any benchmark. And RF is?
RF is risk-free, government bond,
Okay, risk free.
government 10-year
Okay.
bonds.
Okay.
Okay. So
Hmm.
now in similar ways, when you're talking about bonds, right? Whenever we are issuing a bond, obviously I want more than what the government bond is giving, right? I could just buy 10-year RBI bonds and be happy with it without any credit risk. Zero, right? Because government can always print money. Companies cannot. So that means if market interest rates, which is or my interest rate at which I'm issuing is higher than the general market interest rate, my bond will be issued at discount. That means if this is the 100 value as par, then this might be 98 discount.
Hmm.
And premium is also possible. Usually not happens, but it might be possible that it might be issued at 102. Why are we even discussing this is the question, right? And this is par. Par means at 100. Okay. The question is whether it is discount, whether it is premium, or whether it is par. Why are we learning this in FSA is because we want to understand how does it affect balance sheet, because we are talking about balance sheet, right? So how it affects is uh, if we are let's issuing at a discount. So the par value was, let's say, 100 and discount is, let's say, 90. So in the balance sheet, in the liability section, okay, so this is the liability section and I would show bonds. So it is issued at 90, right? So I get 90 only, right? The question is that, and let's say in the asset side, I got cash worth 90. But remember, the investor who has purchased this bond would get interest, or who is expecting that this bond would mature. So maturity value, if in case of discount value, is how much? 100. Maturity value means later on when he will redeem the bond, he'll get 100. Okay. So now the problem is, how will we even show this? Because initial year is fine. This is initial. But how about later? How would we, because this bond value will keep on increasing, right? As we progress towards maturity, the number of years, remember when I was showing you the cash flow calculation out here, as we progress towards maturity, right, the N factor would reduce because you would have lesser years remaining, and hence the bond would eventually now start going towards, where is that value gone? Yeah, this. Okay. So 90 and later it has to be 100 at maturity. Now, the question is, how will we show this effect? Right. So again, similar to equipment purchase, what we do is this difference of 90 minus 100, which is 10, we amortize it. Amortizing meaning spreading the cost. Okay. But where? So in the income statement, whenever we show interest expense, okay, this 10, the difference between uh, par minus your issue, which is equal to 10, you will divide it across n and show it as an extra expense. And that expense would eventually affect, from here, it will affect your bond. Similar, okay, let's take an example for this. Okay, that would be better. This will not come as a calculation, so don't worry about it, because this will come as a calculation in fixed income, not here. Okay, but if you want an example, I will give you the example. Okay, see this example here. Why is this not getting selected? See this. Okay. So if a company issues 10 million of bonds at par value, okay, the bonds are reported as 10 million, no problem. Over the life, nothing happens. But the carrying amount, the date issue, the date of remains. As another example, if a company issue bond at a price of 97.5, so at a discount. So there's a difference of 2.5 million, which needs to be amortized across until the maturity. So this would come in the form of interest expense at the moment. This would be more difficult to explain unless and until we get some, knowledge on bonds. So probably right now, just understand that how the effect happens. Okay, because bonds, pehle aap when you will understand, then only probably this will be easier to understand. Because otherwise, I'll have to teach fixed income for now. Okay, one more effect again. This is something that you will be able to understand. Okay, which is deferred tax liability. Now, whenever we are creating the income statement, so we have got revenue minus expenses, and then we have net income. Now, I don't know whether you are aware of this, but usually when we are making a financial statement, we are making using, let's say, IFRS, right? Let's say in India only, IFRS. Now, tell me one thing. When we are paying income taxes, which standard are we using? When we are paying actual taxes, practically as you and me, are you paying taxes according to IFRS?
according to Indian government.
Uh-huh.
According to Indian government.
हाँ, तो income tax laws ना.
Hmm.
So we are not using IFRS. The government of India doesn't care whether you are using IFRS or GAAP. What it is saying is you calculate according to income tax laws, especially when we are talking about business. Okay. Now, challenge. See the challenge. This is a real life challenge. Okay. So let's say you bought, let me give you an example of, okay, let's talk about a car. So we did a car purchase, and let's say in our financial statements, we used straight line method uh, across, let's say, 10 years. And we got, let's say the car was worth 10 lakhs, and we got a depreciation expense in the income statement as, let's say, 2 lakhs. Okay. You went to income tax filing at the end of the year, and the government of India, as per income tax, says that no, this SLM 10 years doesn't work. What you do, you take 9% rate SLM of the car. So instead of, I'm just making this up, there are different rates for different kinds of equipments, but 9% SLM, okay, you do 9%, but your depreciation would come as 90,000. So now let's take some numbers and you will understand the challenge. Okay. So let's say our revenue was 10 lakhs. Our depreciation expense was 2 lakhs. So our profit before tax is how much? 8 lakhs. So tax at 30% is how much? 2.4.
Hmm.
Let's do the same calculation here. Revenue is 10 lakhs. Depreciation is not 2 lakhs. It is 0.9 lakhs. So my EBT is how much? It is 8.1. Correct? No? No.
Hmm.
No. 9.1. 9.1 lakhs. 30% tax. Can you calculate? Should be somewhere around 2.7. Approximate. See the problem. Okay. Now see the entry problem. So this is according to IFRS, let's say. This is according to income tax. In our balance sheet, in our balance sheet, look at the challenge. From only income tax perspective, okay? So cash, okay, and let's say retained earnings out here. So according to this, 8 minus 2.4, how much will it be? 5.6. 6, right? So my retained earning goes up by 5.6 lakhs, right? After the profit, right? If I do 8 minus 2.4 plus 0.56, okay. But my cash, which am I going to pay tax as 2.4? Actual tax. Am I going to pay this or I'm going to pay this? Which tax are you planning to pay? Are you going to pay to the government of India or IFRS?
IFRS, it's slower,
No.
but we have to pay in Indian government
Government of
tax.
India is not going to wait. No. Government of
Yeah.
India is like they'll send you a notice,
Yeah, so that
right?
2.7 is to be paid.
So they're like, you pay this. Now look at the challenge here. So minus 2.7, right?
Hmm.
Or in fact, I'll make this simpler. I'll not even show you the net income. Okay, I'll just show you the effect. But in your retained earnings side, my tax is reduced as 2.4. Balance sheet is not tallying, right? Because the cash is reduced as per income tax. This has reduced as per IFRS. So what is the difference? 0.4, right? 0.4, no? So think about logically that as per my calculation, I was supposed to pay 2.4, but I paid more.
Hmm.
So later on, I'll pay less. See, overall tax will not change. Total tax on an asset is going to remain the same. It is just about timing difference. Because today they are telling me to depreciate at a higher rate and I have depreciated at a lower rate. And hence, my profit is lower. And in case of them, the profit is higher. But in case of my calculation, I'm supposed to pay 2.4 as tax, right? In case of income tax, I have to pay more. So do I owe them more taxes in the future? Or they owe me more lesser taxes in the future? See, I've paid more, right? So they owe me,
Hmm.
right? So I will call it as deferred tax asset of plus 0.4. And this will be shown, and then this will match. If it was the other way around, that you paid less, okay, or let's say you paid less to income tax. So instead of 2.7, let's say you paid 2.4, and here you showed 2.7, it would be exact opposite. It would be a deferred tax liability. I understood. And this
So,
only I've given you one example of the reasons for this to happen.
so this can go either way, right? Like either government owes us if we pay in excess,
Hmm.
but
So it's not
in most of
actually
the
excess,
time.
it is the timing difference. Please understand, it is a timing difference. Because if if let's say there's 100 worth of asset, right? Or let's say this 100 worth of asset, whether I depreciate using SLM
Hmm.
or whether I use WDV, whichever method, asset will go to zero, right? So the effect cannot be more or less. It is only that, okay, initial years I'm paying more taxes, later on years I'll pay lesser taxes. If I'm paying lesser taxes, I'll have to pay more taxes. It's just the timing difference. Permanent differences can also happen, but that we will discuss in the tax chapter, right? There are a lot of other complications are also there. But what happens practically, I'll tell you. Net, every company is smart enough in the stock market. I'm talking about listed companies to always be in DTL.
No.
I'll tell you why. So why company always is in DTL? Because so let's say we started a company. We bought an asset. Let's say we bought a car. So this is going on depreciation, right? The depreciation is happening. And let's say we are in a DTL situation right now. Do we really stop purchasing any asset.
No.
We never stop. And we always are net DTL positive. So, in fact, later on in the chapters, what we will realize is that as an analyst, okay, we are supposed to take the DTL as convert it for the calculation purpose into retained earnings and take it as equity. Companies are smart enough to pay lower taxes, and they will make sure and they'll use all possible legal processes to pay lesser taxes. It is only the individuals like you and us who pay more taxes. Companies are generally at 15%. Okay, when I say 15%, I mean their interest planning is planned, the way they take loan is planned, all is to manage taxes. Okay, but any questions here?
No, this is clear that we were just comparing what this tax liability is there, deferred tax liability.
Hmm.
More examples will definitely help
So
us.
another example, okay,
Hmm.
another practical example is another reasons for this to happen. Okay, let's say you had salary payable, not salary payable. Actually, let's say uh, you are purchasing, or let's say customer came and paid you cash 100. Okay, INR. I'm talking 100 INR,
Hmm.
but product not delivered. Right? As we know that if product is not delivered but cash has been given, so in my balance sheet it will come as what? Unearned revenue.
Yes.
We already know that. So this will be plus 100. Revenues will have no effect because you
Hmm.
can't show it as unearned revenue, right? It can only come when we give the product. So this is as per what? IFRS.
Hmm.
But when it has paid cash, it means it has come in my bank statement.
Hmm.
Now, as per income tax laws, if it has come in the bank statement, you got to pay tax and you got to show it as income. So now out here, revenue is zero and tax is zero, right? Because
Hmm.
it's not given only. But in terms of income tax, I already have 100 rupees of revenue, so I got to pay 30. So now what will happen in my balance sheet? So in my balance sheet, my cash will go down by minus 30 because of the tax.
Hmm.
But my equity side, the retained earnings, will have no effect because there was no tax. But this has got to balance, right?
Hmm.
So deferred tax asset of plus 30. Okay, many more can be, but usually this situation majorly arises very less due to accounts receivables or revenue related. It will be always more related towards equipment purchase because the rates of amortization and depreciation are very different compared to income tax laws and IFRS because income tax laws are related to managing the country. The government decides on the basis of managing the country, right? IFRS is a more generic, financial statement, right? So IFRS cannot think about India. IFRS is think about all the other countries. And because of those assumption differences, this basically will always keep on happening.
So this DTA, like you just mentioned that the cash is reducing by 30, DTA is increasing by 30. So this
Mhm.
is all on the asset side happening, right?
Yeah, because we have paid more tax, right?
Hmm.
So the government of India owes us. Hence, it is an asset. If we had not paid, but let's say it was ulta,
Hmm.
So we had paid 30 in our income statement, but in case of government of India, we paid 0, then it's a liability, no?
Okay.
So that is what usually you'll target. Rarely will any company be in DTA.
In the previous examples, when we're talking about car sales,
Mhm.
so
Car
this was,
purchase.
yeah, car purchase. So that was opposite, right? Like we had to pay.
No, 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 no. Car purchase. No, no,
So
no.
that was again like, no, we were expecting that 30,000.
DTL. We were in DTL situation. Here it was DTA. Here is DTA. Right.
Okay.
Here it is DTA. Right. Because we paid. Right. We paid more taxes. That is why DTA. Or have I categorized it wrong? No, sorry. This will be, we paid, right? So it will be DTL. Sorry.
DTA.
Plus 30. We paid, right? No, no, sorry.
No,
No, no,
this is
sorry.
a DTA. This is DTA.
DTA, yeah, DTA. DTA is 30.
In the above one,
Previous example,
this is
let's,
also DTA.
no, just give me a second. There is the example. What is the tax? 2.4 and we have paid 2.7. Yeah. So it will be DTA. This
This
all
is
will
also
be
DTA.
DTA.
I just,
Yeah. If this is 2.7 and this is 2.4, then this will be DTL. But usually this situation will never happen. More taxes with the government of India will never happen. Because personally also when we are managing our business, the rates of depreciation that we are taking uh, are towards the higher side only to reduce the tax. Right? Anyways, so this is one example. Permanent changes can also happen. Okay. Although this is not given here, but I'm permanent, difference. See, right now we talked about temporary difference, right? Timing difference, right? It's just the timing difference. We are paying faster, depreciation is happening faster, depreciation is happening slower. Permanent changes can happen if, let's say, there is a equipment that we purchased, okay, and suddenly that equipment is of no use. I mean, we just threw it away. So the entire asset itself has come to a stop because we can no more depreciate it and we have already taken the effect, but in the balance sheet, the asset does not exist anymore. Or let's say we talk about that example that we had taken, we had radios in our balance sheet and we were nicely depreciating it across years, but the value of radios went down in the market because the value of radios itself, because people started using, let's say, uh, music systems, and radios had no value, so it caused impairment, and because of the impairment the asset value only goes down, which was initially when calculating depreciation was not there. So let's say the radio was at 100 initially to calculate depreciation of, let's say, 5. But later on, due to impairment, the value of radio itself has gone to 20. So even if I do the depreciation, it is 1 rupee. So this change will never reverse. Okay. A lot more examples are there for that in tax chapter. If hopefully if the CFA Institute has kept that kind of complication. Okay, but remember that this calculation will never come. Okay, do not spend too much time in the calculation. What you need to understand is at this moment, what are the disclosures related to DTL and DTA. So a lot of details are actually given about this DTL and DTA. But again, practically speaking, when analyzing companies, you never come across that level of information, right? I'll tell you what is the challenge. Whenever we are analyzing a company, we get equipment as the category, right? I do not get what equipment. And I do not get, okay, car or chairs, which chairs. I do not get that information. So it is only to a limit that you can infer something from here. Okay. Beyond a certain limit, you will not have that kind of information. Okay. Now let's come to some ratios of balance sheet. Okay. So okay. Now, please understand, never do we take ratios just to analyze companies. It doesn't work. It's usually used to filter out companies. It is to a certain quality of the company. Okay. So what are the balance sheet ratios that we take? One is from the liquidity side. So when we are saying liquidity, what are we saying? Ability to meet short-term needs. For example, in your personal case also, even if you're investing in, let's say, equities and you're not taking a lot of risk in the stock market, you should always have 6 months of, or at least even 1 year of liquidity needs as cash invested in, let's say, short-term bonds or even liquid funds, right? So similarly, when you're looking at business, why is liquidity important? Is because a lot of businesses, what is the reason for businesses to go out of business? Do you know? Majority of the reason why initial businesses go out of the business altogether, they are wiped out. It is because of lack of liquidity, mismanagement. It's never majorly because of business ideas, it is mismanaged working capital, right? So, lack of liquidity. So, how do we measure it? One is we are measuring current assets against current liabilities, which is we are saying that all of these current assets, this ratio, what it is telling is all of these current assets are liquid enough to cover up all of these current liabilities. May not be the case because current assets include inventory, right? It and one of the biggest problem with current assets is accounts receivables, right? Accounts receivables most of the time might not be even worth anything, right? If the company is like Cox and Kings, which had billions of receivables, this will be a wrong benchmark to cover the liabilities because the liabilities are true. Liabilities are always true. So current assets. So this would be current assets over current liability, which is the current ratio. Okay. So since we are saying that inventory out here is not liquid, right? So what we do is we remove that part. So current assets, I'm just simplifying things, okay? So current assets minus inventory versus to meet the needs of current liability. That would be CA minus inventory divided by current liability would be quick ratio. Okay, although in the curriculum, it does not mention current assets minus inventory, but I'll tell you why this is important to know because a formula you can always not remember all the kind of current assets, no? So you just need to remember that which one to remove. So it is always inventory to remove in case of quick ratio. Okay. Third is cash ratio, which is, I'm just saying cash plus any short-term investments. For example, short-term liquid funds, short-term bonds to cover all the current liability. So this would be what? Cash ratio. Okay. This quick ratio, by the way, is also called as asset test ratio. So this is basically liquidity in that sense, uh, in terms of ratios. Practically, again, these ratios are already calculated in the market. We don't really have to calculate nowadays. In fact, companies tend to present all of these ratios in the annual report itself. So we never have to calculate this. As we progress, we'll understand what are the other ways of doing it. Okay. Solvency. When we are saying solvency, what are we saying? We are saying long-term leverage. So again, we need to first understand that whenever we are saying leverage, leverage is not bad. Let me first clarify this, because later on we keep on thinking debt to equity, meaning if the debt is higher than equity, it is always bad. Not really. It's good. It's always good, because if you are getting leverage at a lower cost. See, we calculated CAPM, right? So CAPM is RF plus beta into RM minus RF, right? So this is cost of equity, right?
Hmm.
What is cost of debt? The interest rate only. So now you tell me which one is costlier,
CAPM, cost of equity.
right? So cost of equity is always higher than cost of debt. So whenever we are saying cost of equity, it is your own money, right? Own
Hmm.
money. So your own money should be invested at higher returns. So if you are able to create a mix of this, you can significantly reduce the uh, cost of capital. Okay, now, so how do you measure it? So some of the solvency ratios which are given is long-term debt upon long-term equity. Okay, this is one ratio. Debt to equity, we all know debt times equity. It is not debt upon total capital, it is debt to equity. So if debt is 50 and retained earning, so whenever we are calculating equity, please remember it is retained earning plus contributed capital, both paid up capital plus retained earning, both. Okay. Third, let's say, okay, total debt. So total debt upon total assets. This you have to interpret it in a way. Okay, this doesn't directly make sense. What it means is how much of your assets are funded through debt. You can, if you want, you can make a notes of such ratios so that whenever you are interpreting, you know what you are saying. So this is saying how much of your assets, right, is funded through debt. Okay.
This D2E ratio, what you have calculated, written here.
Uh-huh.
So that
Debt
is
to assets, right? Or your debt to equity, you're saying?
the debt to equity, the one that you
Uh-huh.
have written at the top of it.
Yeah.
Okay, so this one equals to what? I couldn't understand what is there on
Debt.
the.
So, for example, if you have loan
Hmm.
of 50 and
Ah,
on
okay.
your equity side, you have retained earning of, let's say, 100
Hmm.
plus contributed capital of 50. So equity has two parts, right? One is the when you start the company, investors must have infused the capital, right?
Okay, so that
That
is
is
contributed.
contributed capital. This
Okay.
is coming through net income, right? Every year accumulating.
Hmm.
So
Retained
both are
earnings.
equity only, right?
Hmm.
So this is 150. So this will be 50 upon 150,
Hmm.
because this money belongs to equity shareholders, retained earnings, right? Every year, whatever profit you're making is retained earnings accumulating in the balance sheet. Understood? Is clear?
Yes.
Okay. Now, this is a very nice ratio which I actually like. Assets over equity. In fact, whenever I'm looking at leverage, I'm always looking at this ratio, assets over equity. You would be like, okay, well, it doesn't make sense, right? But it actually makes total sense, because if you see, if your assets are high, but your equity is low. Okay. Assets are high. That means a lot of assets are there, but your retained earning plus contributed capital is low. What does this infer? That assets are funded through
Equity.
debt. So, equity is low,
Oh,
assets are
equity is low,
high.
yes. Assets
So
are
the ratio is ulta. Matlab it is not direct.
very much
Okay.
dependent on
Higher
debt.
the ratio, it means higher the leverage,
Hmm.
right? So financial leverage ratio is actually the most common ratio to use, because here you do not look at debt, because it's very difficult to get the debt value. Sometimes it might be hidden, sometimes it might be current, non-current, who knows, right? So instead of doing that, we go into other asset. So we go to assets and we go to equity and then infer, okay, what is the leverage? See, because otherwise you might be thinking that why are we doing the calculation this way? Why are we comparing assets to equity? Why not directly just be happy with debt to equity, or why not happy with debt to assets? The reason is because remember when I told you capitalization of interest, when we are developing the asset, that interest is becoming an asset, right? Remember, we spoke about development of an asset. If let's say we are constructing a road, but the road is not completed, whatever cost I am incurring in between as in the form of interest, where am I putting it? I'm putting it in assets, right? So all of that would get missed out if I'm just comparing debt to equity. That is the reason why we have ratios like this.
No,
If
but just coming back to this one,
Mhm.
we spoke about debt to equity ratio, right?
Mhm.
Then we looked into total debt by total assets, where we are saying that we are just comparing how much of our asset is,
Total debt to total assets.
yeah, total debt to total assets. So, but what is the inference in terms of, like, now when I get a number, like, for
Total
example,
debt to total assets, you are saying that how much of your assets are funding through total debt. Yes,
so if
it's
this
an
ratio is
asset.
less than one, then
So that doesn't work like that. See, that is how people actually used to talk.
hmm,
It is not about one or two.
okay,
It is never about you. Nobody can say this is the ratio that should be followed. That is all crap, because you have to look at the industry. Okay. One is to look at industry standards. What are your competitors doing?
hmm,
Another is to look at the trend. This is the trend and this is the industry. So if in the industry, for example, if you're talking about manufacturing, the debt to equity ratio will always be high.
hmm,
There's no other way to fund it, right? Right. For example, if you're talking about petroleum, pipeline companies,
hmm.
right? They will raise debt. There's no other way to. So your debt to equity ratio will be high, and you might say that, oh, debt to equity ratio is high, company is bad, right? But you have to look at the industry. Now, if it is a software company, let's say we're talking about IT company, most of the companies are debt free.
Hmm. It's all equity, mostly equity.
Mostly equity, because they're service based company. They don't have to purchase any equipments, nothing. It's all people based company, right?
Hmm.
So suddenly now you're analyzing and you see, even if you see only a 0.1 debt, then that is a cause of concern, right? Why is there a debt? Because because Infosys is debt free,
Hmm.
TCS is debt free, right? Most of the IT companies are debt free. So even a one ratio would be questionable, right?
So, what kind of questions do we expect when we see these ratios?
So we'll do questions. So questions will be on, they will give you examples,
Hmm.
they will give you the inferences, they will give you the calculation what to do. Generally, they will not ask you what is the standard, that you know, everybody understand that that is not how it works. Right. So I'll give you some, we'll do some questions on ratios. Okay. So you come to page 118. Let's come to page 118, question number 12. Okay, and I'll just be back. Okay. You have the question ready?
Question number 8, right?
12, 12.
Question number 12.
I said page number 118, right?
Hmm.
Yeah. So you can see out here, they've given you, this is how the questions will be. Okay. So they've given you company. See, as I said, industry average.
Hmm.
Always. This is only in MBA syllabus that they talk all this debt to equity ratio 2:1 is bet. All that is crap. Okay. So look here, current assets are given. Okay, let's look at the first question. What does the first question say? Okay, the quick ratio for company A.
Hmm.
Okay, so let's calculate the quick ratio for company A first. Let's do this one question. One question is enough. The quick ratio. So quick ratio, remember what I said? Current assets minus inventory divided
Inventory.
by total current liabilities. Let me open my calculator. And if you have not purchased, let's say, the BA Plus calculator, what you can do is there's an app available on BA calculator, BA2 Plus, Texas Instruments.
Hmm.
There's an app available. You can use it for now. In the exam, uh, in my experience, and probably this is right also, too much is spoken about the calculator, very less is actually used.
Okay.
Don't obsess too much on the calculator. It's only in time value money calculation that sometimes you have to use calculator. Most of the time it is plus and minus. So don't spend too much time on learning shortcuts. It's useless. Okay. Quick ratio for companies. Okay, let's look at what are my. So total current assets, what we can do is we can just do total current.
0.57, right? For question number 13, we are looking at quick ratio.
Yeah.
I'm getting 0.57 for this.
So 12,
Okay.
how did you do 35 minus duty?
35 minus inventory, that is 15. So
Correct.
we get 20, and then that is divided by
Divided by
current
total
liability,
current liabilities.
35.
Total liabilities 35. Huh. So divide it
0.57.
0.57. So B, right?
Yeah.
Okay. 14. The financial leverage ratio. Remember assets upon equity.
Hmm.
Whenever you hear financial leverage, remember it is the indirect calculation. You are not looking at debt. You're comparing all the assets to equity. So total assets is 100 and total equity is also 100, right?
Hmm.
Assets over equity, right? Assets, company B or company A?
Question
Financial,
14, you're asking?
no, no, the question they are asking for different ratio.
Financial leverage ratio for company B.
Wait. Total assets over total equity, correct? Total assets over total equity is 45. Total 100 over 45.
Total
Total assets for company A, B is
yes.
100 and total equity, shareholders equity is 45.
Current liability.
2.2.
How did you get the equity part?
Don't look at total liabilities, look at total shareholders equity, just above that.
Ah, okay, 45.
Yeah.
Right.
Right. Sanath, you're getting it, right? You can,
Sir, I will revisit it later.
sorry?
I will revisit it later because I was doing something.
Acha, acha, okay. So calculate which ratio indicates lower liquidity risk for company A compared with company B. Which ratio indicates lower liquidity risk for company A? So you'll have to calculate the ratios. Okay.
Hmm.
So let's calculate cash, quick, and current for A and B.
Cash ratio, quick ratio, current ratio.
Yeah. So we can just write company A and B.
What is cash ratio? I just forgot.
Cash divided by total liabilities. Cash
Okay.
and marketable instruments, if there are any short-term investments that the company has, which they have as marketable securities, right? So current ratio, then we've got the quick ratio, and we've got the cash ratio. So company A, current ratio, I suppose we already had calculated 35 divided by 35 divided by total current liability of 35. Yeah, so 1. And for B, it is 55 divided by 25. Is 2.2, right? Then current assets, we had quick ratio had calculated, right? 0.57, right?
Hmm.
For company A. For company B, it is total current assets, which is 55 minus inventory, which is 20, divided by current liabilities, which is 25. That is 1.4. And cash ratio, which is total cash and marketable instruments. So that is 10 divided by total current liabilities, which is 35, 0.28. And company B, which is 5 divided by 25. 0.2. Okay. Now, please also put the industry average because that is what we need to also see. Okay. Anyways, first let's just look at the ratio itself. So, which ratio? Now the question is which ratio indicates lower liquidity risk for company A? Lower. So, if we see lower liquidity risk, probably we would say cash ratio. This cash ratio is higher for company A, right? All the other ratios are lower for company
Cash ratio.
A, right?
Hmm.
So it has to be cash ratio. Okay. So these are the kind of questions basically will come in the the exam. And you have to
Okay.
keep on asking. I mean, you have to keep on doing questions. That is why I shared that entire the question bank.
So here, when we are talking about cash ratio, we have just considered cash, right? There are no equivalents as such.
In case of company B, there is
Okay,
nothing.
cash and cash equivalents. Okay.
Company B, there is no cash equivalents. But in case of no, but you have to also use marketable securities. Remember in the ratio formula that we had discussed, it is cash plus any marketable securities. Marketable securities are those securities that we were talking about initially, financial instruments, or let's say mutual funds that the company has.
Hmm.
So that would also be cash equivalent.
So this is again like the variety of questions we practice will.
But that is why the variety of questions, but you have to limit. Uh, if you want to know the expected exam, the
Hmm.
exam will be like this curriculum.
So here, like when we are talking about cash ratio of company A, so we have just taken 5 plus 7. This is no 5 plus 5, right?
You have taken 5 plus 5.
Okay.
Company B does not even have marketable securities, right?
Cash ratio. Okay.
Cool. Let's move. Let's take a break first, right?
Okay, then I just need 5 minutes to
Yeah. Yeah.
revise. By the time you're back, no, I just wanted to ask one question. Like,
Uh-huh.
what is the actual thing asked in this question was,
Uh, Which question are you talking about? 15.
no, the 15 we just completed, right? We are talking about lower liquidity risk for company A.
Which ratio indicates lower risk for company A?
Yeah.
So which, see, can you see my screen, right?
Yes.
So if you see, in case of, let's say,
Hmm.
current ratio is higher for company B.
Hmm.
Quick ratio is higher for company
Company
B.
B. Hmm.
But only for cash ratio, company A is higher. So
Hmm.
which of the ratio it is asking indicates lower
Lower
liquidity risk,
liquidity risk.
which can also be called as higher liquidity, right?
Okay.
Lower liquidity can only happen because of higher liquidity, right? Lower liquidity risk. This is
Hmm.
risk. So what they're trying to, why this question is sounding difficult is because it is not asking for which company has higher liquidity.
Hmm.
It is asking the other way around, which indicates lower liquidity risk. So this you can
So that
expect
means,
in the
yeah.
interview.
So
Yeah,
we have
sorry,
more this one.
words.
Good. So again, going back to the information what they have given, so we have market securities plus cash in company A. So
Correct.
this is evident, right?
Correct.
More liquidity. Okay.
Correct. But see, na, see the interesting part is if you see company B,
Hmm.
right, in the lower stringent ratios like current ratio,
Hmm.
it's doing well, right?
Hmm.
See, it is actually better, looking better here. See, it is looking better here. But as
Yes.
soon as you remove all of that accounts receivables and you know
Um,
inventory, then it goes down here. See,
yeah, that is the only reason I just went back and saw the total current assets. So current assets of company, even though being high, the liquidity risk is higher.
so actually, may what you should never, in reality, if you were putting your money in a company, you
Hmm.
would look at cash and marketable securities. I would, or yeah, I would only look at cash. In fact, I would only look at cash,
Hmm. Liquidity basically.
liquidity, and their operating cash flow. See, that is why
Okay.
this ratio analysis cannot be done in silo from the financial statements analysis that we are doing, right? So this is just one indicator, right? But
Hmm.
when I'm looking at, let's say, cash ratio, I also need to look at this is the cumulative, right? It is in the balance sheet. But
Hmm.
what about the source of this cash, which is going to come from regular cash flow from operation in the cash flow statement?
Okay.
So the analysis of cash flow statement is even more important because if the company does not have operating cash flow,
Hmm.
then we are gone,
Yes, yes, yes.
right? So this has to be done in tandem with everything,
Okay.
right? Let's take a 6 minutes break.
Hmm.
Let's continue with the next chapter. Yeah.
Okay.
Okay. Okay. Let me know, yeah, you guys are back or not.
Yeah, Alan. You're back.
Great. So now things are becoming a little more serious as we progress through the content. Now you
Yeah.
understand,
I
right?
was just wondering, we have been, this is the fourth lecture for us,
Yeah.
and we have covered so many topics. And now, whenever we go back to the curriculum, we are almost in page number 100. So, how do we relate whatever we are learning in the class and going back to the curriculum and reading it there?
So see again, curriculum, remember whatever I told you first, always look at the learning outcome.
Okay.
All the contents in the curriculum is not important
Hmm.
because CFA tends to give a lot of examples. Okay. And if by chance you, so for example, now in let's talk about the first chapter,
Hmm.
introduction, right? So in introduction, generally you just need to know the framework of analysis, right? Framework of financial statement analysis. How does financial statement analysis work? And also some understanding of what are the sources of information. For example, annual report, quarterly report, right? So
Hmm.
this is where whenever you're looking at the content, this is what you need to focus on. Rest everything is to explain this only, right? So this
Okay.
first. Second is I think we started with income statement,
Hmm.
right? So income statement, you need to understand what is the format, right? What is the format of an income statement? What are the various categorization of expenses? So we remember we spoke about first was the matching concept,
Hmm.
the matching revenue and matching expense,
Hmm.
right? Then I'm not sure whether ratios are there a part of it, but yes, ratios. Uh, I think we skipped the ratios. We will do that ratios in the income statement chapter. So now these three is the major topic. Okay,
Okay.
income statement. Now there is a lot of other content which is given, but mostly it is to and I'll tell you a trick also on how to identify which is the important part apart from the LOS. So this is usually where I'm coming from is learning outcome statements which are in the first page of every chapter. It is written.
Hmm.
And please, what you need to do is look whether it says describe,
Hmm.
demonstrate, or calculate.
Okay.
When it is describe, you cannot expect questions, calculative questions on that. Right. But if it is demonstrate or calculate, it means you calculate, right?
Okay.
There
Okay.
is one more calculation of EPS here.
Hmm.
So four topics. Okay. Then in the balance sheet, okay, generally speaking, we spoke about goodwill.
Hmm.
Majorly, it was about intangible assets first. Okay. Then we looked at financial instruments,
Yeah, today we covered that. Yes.
right? And some ratios. Balance sheet has actually not doesn't have much because balance sheet is the outcome of all the other statements.
Hmm.
So these three topics. So you look at the LOS, look at the content, but while looking at the content, the easiest way to look is through look at the end of chapter question.
Okay.
So, for example, you might see EPS and just go to the end of chapter and see how is EPS getting tested.
Okay.
Are they asking you to calculate, or are they just asking you questions related to, for example, in case of this financial instruments,
Hmm.
we discussed in detail, but there are no questions related to it,
Hmm.
right? They might just ask you, okay, what are the three categorization which will affect income statement balance sheet, but they're not telling you to calculate,
Hmm.
right? So this, for example, this has to be done. You have to check it this way because now when I was doing CFA or our syllabus in 2013 had calculation also.
Okay.
So that time we had to calculate, right? So this is how you figure out. Otherwise, you will get lost in the content.
Hmm.
So LOS, whatever I am teaching in the class, that is absolutely how what is expected, and cross verify with EOC questions.
Okay.
And whenever you find questions even inside it,
Hmm.
okay, so one is EOC question and one is also called as the blue box question.
Yeah, the examples, right?
Yeah,
That
you
we.
can do that, but remember that caselets kind of questions in which there's a lot of
Yes.
data,
Yes.
those will
Yes.
not come in the exam.
Hmm.
This is just for practice. But
Hmm.
these are the best questions you can do because see, it's like volume versus quality.
Hmm.
So there are a lot of other service providers will give you like billions of questions, but you are just wasting your time. So if you just do blue box, you do EOC, and you do a little bit of mocks and regular practice, without doing too much of hard work in terms of volume, you can still pass the exam very nicely because these blue box question are very conceptual questions.
Yeah, I just went through like no in chapter two income statement. They are very comprehensive. Like they will make sure that all the concepts you have learned are applied.
Yes. Right. So that is why, and if you do those questions, blue box, which I am trying to take the example, I'm just taking the data from there and we are doing it in the class. You must have realized that
Hmm.
for example, in case of financial instruments, when we did that blue box question,
Yes.
there was no doubt after that.
Hmm.
So this is the beauty of using the curriculum because curriculum will ensure that you finally pass the exam. There will be no confusion and a doubt कि यार exam में, how are the questions going to come. You will never be in that situation.
So this is NCRT for board exam then.
Yeah, in case of CFA, it's always NCRT,
ठीक है.
right?
Done.
And I don't know why people propagate so much about using derived content
I
because they
was
want to
speaking
look
with
at
my
smaller
yeah, I
volume.
spoke with all of my colleagues who are there, like no, who have the CFA charter now.
Mhm.
Everyone is asking, just go with Schweb, Schweb, Schweb. I said, okay.
I know they will say Schwezer because see, right now you might be using a digital PDF, right?
Hmm.
So, but what happens is when you actually order the curriculum books once you register, those are pretty huge,
Hmm.
right? So that is intimidating. So all that Schwezer does is what we are doing in the class. It takes away the relevant part.
Hmm. Hmm. Hmm.
The only problem is like, for example, now if we were looking at financial instruments, it would just finish it off,
Hmm.
and then there will be no those blue box kind of caselets.
Also,
Now,
is there
whether
a
it is
reduction
Schwezer
in
or
the
whether it is, sorry,
is there any reduction in the content of CFA now?
there's a lot of changes which I saw.
Okay.
Okay, what I am seeing right now is a pretty condensed version of, I suppose it is correct also because a lot of part is not even required. What we used to do earlier,
Acha.
like for example, held to maturity calculations and all that, I think it was unnecessary. In fact, in this chapter also, I saw you will come to know when we'll be doing cash flow calculations that there's one part of indirect method calculation which industry, not even 1% of the companies are presenting their financial statements using the direct method of cash flow statement. So it is really unnecessary to do that, but somehow it is still. So that will also probably change. Something else will come.
Mhm.
Right. Okay, let's start with cash flow statement. So again, always look at the LOS. It says describe.
Hmm.
Okay. So the first LOS says describe the linkages of the income statement with uh, income statement, balance sheet, and cash flow. I mean, in summary, if the first LOS says describe the linkages of the cash flow statement with income statement and balance sheet. That is the reason why we did that sheet to clarify that. Okay. And when we'll do it now, you'll realize that it is slightly easier to understand. Okay. Then second LOS says describe the steps in the preparation. Steps again, describe only, but
Hmm.
steps in preparation of direct and indirect, which will be discussed, cash flow statement. Okay. including how cash flows can be computed. Okay, so that is the steps itself. Now, third is describe, again, demonstrate. It is saying conversion of cash flows from indirect to direct. Now, this I felt is absolutely unnecessary because this is not possible in the real life. Okay. And the final LOS says contrast IFRS versus GAAP
Hmm.
in the reporting of cash flow statement. So why? Because there is cash flow from operations, cash flow from investing, and cash flow from financing.
Hmm.
So whether interest would be part of operating expense, operating cash flow, or financing cash flow, that is the difference basically we're talking about in this last part. Okay. So now this is what the LOS is. Now we start. So when you are studying, what you should do is you should go back to the end of chapter question and see what do they mean by describe the linkages of the statements. In fact, you can go right now only and see. So let's go and check some questions. You can open page number. Okay, so go to page number 149.
Hmm.
Okay, so look at what the question says. Based on the information for Pinkerley Inc., a fictitious company, what are the total adjustments for the company would make to net income to derive the operating cash flow? That means basically what you're saying is you have your net income or your income statement.
Hmm.
Now calculate operating cash flow. Okay, because this is a long word written here of total adjustments, etc., etc. But all you're trying to say is that how do you calculate CFO,
Yeah.
cash flow from
We have
operation?
to like, yes, वो cash
Right.
flow बनाना ना, so yes.
And the question does not look that difficult. See, because they've given you accounts receivable, inventory, and accounts payable.
Hmm.
Right? Now, all I need to do is I need to. So the question is, so when we look at the LOS, it looks very big, right? Now come back to now. Look, you looked at the question, right? Now
Hmm.
come to the chapter and see that there will be a lot of content which probably does not even make sense, or makes sense, but probably I don't need to go through it.
Yeah, like questions won't be asked from that content.
Yeah. So now if you see page number 125, it talks about the linkages of financial statements, right? Now see how much pages got wasted because it's not wasted actually because not everybody will be going through a class,
Hmm.
right? So it is starting with primary financial statements, right? Then
Hmm.
it is talking about relationship between financial statements, right? Which is already discussed. Then it is now see the approach that it takes is in page number 127.
Hmm.
Let me see if I can share the document.
Hmm. Interaction between financial statements,
It
yes.
looks very complicated, no? Linkages between current assets and current liabilities.
uh,
It's one and the same thing. Like, why are we discussing it one by one, right? So, so that is why the content becomes bigger.
hmm.
Understand? So that is why look at the end of chapter question, then come back to the content and follow what is happened in the class. It won't take much time. In fact, it will take lesser time than Schwezer.
So basically, like, no, again, to follow the quant approach, like look into the question,
Yeah,
what to
yeah, yeah,
study, what are the
absolutely.
options. Yeah,
Of course. Because we have to still stick to what we need to achieve, which is to clear the exam.
correct. Yeah, clearing the exam is the
The most
like,
important thing,
yeah.
right? So now let's look at the first content, which is on the linkages between the financial statements, in which we will directly come to linkages between current assets and current liabilities, which probably will make a lot of sense initially only
Hmm.
since we've done the mechanics file.
Okay, can you just adjust your screen? It is getting a little blurred.
Is it?
Do you use some stylus or something, or like?
Yeah. Yeah, this is iPad.
Okay.
So this is current assets. Now is it visible?
Yeah, yeah, better.
So current assets and current liability linkages is what we want to talk about, right? So think about this. How is current assets actually linked to the current liabilities? Through a very simple mechanism, because cash
Hmm.
is current assets. But let's say deferred revenue
Deferred revenue. Okay.
or unearned revenue,
Unearned revenue.
right? Unearned revenue is linked to cash, right? So if a
Yes.
company, if a customer pays advance of, let's say, $100 for, let's say, a magazine subscription example that we are taking.
Hmm.
So in that case, your cash is going up, right? Your deferred revenue is also going up. But in your income statement, revenue has no effect, right?
In income statement, my
Because
revenue.
revenue, if it is earned revenue, then it would come in income statement, right? Customer pays an advance, but you have not given the service. So
This will only happen when we deliver, right? Yes.
yes. So revenue recognition principles, right?
Yeah.
So that's how current assets and current liabilities are obviously linked. We can also look at some more examples given in the curriculum. For example,
So
uh,
there's the new chapter that we are starting, right?
yeah, cash flow
Cash
statement.
flow statements. Okay.
Okay. Okay, there is an example here. I'll paste it here for you to refer in the chat box itself. Okay. Look at the data there. Okay. So assume fictional company ABC, a retailer, purchases $100 of inventory on 1st January of 2001, let's say, on credit. So let's say that we write down this details. So we are talking about ABC company, a retailer, which has first bought inventory worth USD 100. And if we look at the date, then this is 1st Jan of 2001. Okay. On credit. So payment mode is credit, no cash.
Hmm.
Okay. With payment due to its supplier in days. So due is in 30 days. On 1st February, so now we date has changed. 1st February 2001, ABC sells the product for 150. Okay. So now we are talking about type of transaction. This is purchase and this is sell, right? So
Hmm.
now it is selling at USD 150, but payment is again due. Okay. Payment is due in 16 Feb. So in 16 days.
Hmm.
Okay. Customer X pays for the product on 15th Feb of 2001. This series of transaction would affect the financial statements as follows. Now let's look at now forget about the example now. Now we can just look at how it affect. Okay. So let's talk about income statement. Let's talk about balance sheet and let's talk about
Cash flow statement.
cash statement. So you bought inventory. So we all know that when we are buying inventory, it will not go to the income statement until and unless I am selling. Okay. Because we bought it on 1st Jan and we are selling in 1st Feb. So
Yes.
1st Jan, so date, I'll also put the date. So 1st of Jan 2001, right? In
Hmm.
income statement, there is no entry, but in the balance sheet, I put inventory as plus 100. But we have not paid. in cash. So this is the asset side. So in the liability side, I will pay as accounts payable
Accounts payable.
plus 100
This is total credit. Okay.
total credit, right?
Hmm.
Now, let's for suppose see the cash flow statement also at that same period. Since
Hmm.
there is no net income because we have not sold, so net income is equal to 0, right? Any other adjustments are also 0. But still there is working capital, right? Because we have still bought the inventory even if we have not paid in cash, right? So changes in inventory, if you remember, changes in inventory and changes in accounts payable. I had told you that in case of assets,
Hmm.
you do last year minus current year
Current year
for calculating the cash flow. And if it is a liability,
uh,
we do this year, current year
minus last year.
minus last year. This would give you the exact sign
Hmm.
for cash flow statement to be done only for cash flow statement. Okay. So now see changes in inventory. So last year was what? 0.
Hmm.
So in case of inventory, it will be 0 minus 100 because it's an asset. Last
Hmm.
year minus this year. And since it is accounts payable, right? It is a liability. So it is 100 minus 0.
Hmm.
So net 0 effect. And here also no effect on cash.
Hmm.
The reason why there is no effect on cash here is because there is no effect here.
Didn't get one. Like there is no effect on
See,
cash because we are
because
talking.
there was there in cash transaction while purchasing?
Hmm.
No. But I am just showing you that why there was no cash effect. Because even through cash flow statement, if you calculate, there is no effect on cash. See, your inventory increased,
Hmm.
but your accounts payable are also increased. So both cancel each other out. There's no cash transaction.
So just talking about cash flow statement from the beginning, we are looking at net income. So there is no revenue
This
change.
is not there. This is not there.
Yeah. So when we
Right.
talk about this linkage is again coming from our income
Balance sheet.
statement, right? So
Balance sheet. Balance sheet. No, this forget about this. This I've just done it for illustrative purpose. That this is the
okay.
format of the cash flow statement.
Hmm.
But see the linkage, no, in the balance sheet. How the inventory, right, is getting affected is affecting your cash flow from operations. See,
Hmm.
your
So
inventory is finally at the initial stage when we purchased, but without cash. Now, in first Feb, see what happens. Or whatever. I mean, first Feb, now we are selling.
hmm.
Now we are sold. See, what does the data say? We have sold. That means all the obligations are done for selling. So now the income statement will have values, no?
Hmm.
So in first Feb, my income statement will be plus, what was the selling price? 150,
Hmm.
right? 150 USD,
Hmm.
right?
So this
Now,
is again an entry in the revenue part, right?
yeah, this is the revenue part, right? Now, remember that matching concept. Now the cost has to come to income statement for the product that we are selling. What
Hmm.
At what cost did we buy? 100.
100.
It is in the balance sheet at 100, right?
Hmm.
So let me use some other colors. Okay. So for example, here you have, where is the inventory here? Now this, since we are selling it,
Hmm.
so this cost will come as minus 100 in the form of cost of goods sold,
Cost of goods sold.
right? So your inventory would go down, right?
Hmm.
So 150 revenue,
Hmm.
100 cost,
Hmm.
that means 50
50 is
gross
the
profit,
yeah.
right? GP.
Hmm.
Now look at what is the adjustment entry in balance sheet, because balance sheet has to be adjusted right now.
Hmm.
So now my asset side, my inventory will be 0.
Inventory will go down, yes.
So now it is 0.
Hmm.
But look at the data, it says that the customer is not paid.
So this is
He'll
again
pay due. So accounts receivable plus
the customer is not paid. Yes, accounts receivable will go up.
150,
Hmm.
right? Now, the problem is, what about this 50? You might say that, okay, what do we do with this extra 50? Because inventory, I understand, it
Hmm.
is directly becoming zero. But what about the 50? Because although accounts receivable has come as 150, now
Hmm.
let's look at the equity side, the retained earning side.
Hmm.
This 50 would come here,
Yes, equity will
profit,
retained earnings. Yes.
right? Uh, and your inventory has gone down by minus 100.
Hmm.
So net basically you have a plus 50 adjustment,
Hmm.
right? Now let's look at consecutively also look at cash flow statement.
Hmm.
Okay. Now you have a net income. Net income is plus 50.
So that earlier liability is still there, right? Like what we mentioned in January part, that liability of 100 is still there.
Ah, that is there. I'm just not doing that adjustment part.
Okay, okay.
And because we have not really paid, I don't see that
Hmm.
we have paid that
No, I was
parameter
just
anyway.
looking into like no how it is balancing so that 150 is coming like this.
Yeah,
Okay.
you can write accounts payable, you can write it. It will come up, right? I'm just doing the changes part.
Okay.
Now, net income, depreciation I'll not put. Okay.
Hmm.
Now, again, let's do changes in the working capital accounts. So, inventory, last period was how much? It was 100.
0 minus 100, yeah.
So, let's write it as changes in inventory.
Inventory.
So, last year is 100 and now it is 0. So, which is equivalent to 100,
Hmm.
right? Changes in accounts receivable. Last year is 0. This
Hmm.
year is 150.
Hmm.
So this will be plus 50, right?
0 minus 150
Sorry, minus 150. I'm sorry.
minus.
Minus 150,
Hmm.
right? Any other accounts anyways have not changed. Only inventory and accounts receivables have changed. So this would give you a net effect of minus 50.
Minus 50.
So this is changes in working capital accounts,
Hmm.
right? Any other effect that has changed?
Working capital accounts, that means like we are talking about your net cash flow, right?
Yeah.
Okay.
Right. So changes in working capital accounts plus net income. So that is finally again, while selling also, since we have not got the credit, we have
Hmm.
not got the cash. So even though net income is plus 50, but it changes in working capital is minus 50.
Minus 50.
Again, zero. So cash has not changed till now. But now there's a third point. Third entry, what it says is on 15th Feb. Okay. Now, as
What was the last entry here? Like net change,
in
changes
working
in
capital, this effect.
So this is the minus 50 that we are getting. Okay.
And this is the net income. So net income
Hmm.
is plus 50
Hmm.
because of income statement,
Hmm.
and due to balance sheet, working capital accounts, we are getting minus 50 as the changes in working capital. So the net change is zero,
Okay. Looking at the three statements across. Okay.
right?
Income state. Okay.
Right. Now, final effect, which it says in was on 15, as the customers were due to pay us cash, right, on 16th Feb.
Hmm.
So now third effect I'm saying. Now the customer clears the due.
Okay.
So remember in our balance sheet, we had accounts receivables as how much? 150,
Hmm.
right? Inventory is anyways gone. Cash is at the moment zero, right?
Hmm.
Net income, we have already done the adjustment,
Hmm.
right? Now what will happen? Now, since the customer has cleared the due, your
So
accounts receivable becomes zero.
zero.
but your cash will become 150.
150.
Again, in the balance, when you will calculate the cash flow statement, let's suppose right now net income, there's no effect because we've already taken the assumption, right?
But
150.
for this one, there would be no change in our income statement, correct?
Yeah, no change. This is what cash flow is always about change.
Hmm.
There is net income is about income for a particular period. Cash flow
Hmm.
statement is always about change. Okay. So cash flow statement you can make weekly, monthly, quarterly, however you want.
Hmm.
So now net income has no change, right?
Hmm.
Depreciation, there is no change.
Hmm.
But now working capital accounts have changed. Which one is accounts receivable? So changes in accounts receivable will be last period is 150 and this period is 0. So it is plus 150, right? Last year minus this year.
Hmm.
And cash. So now you don't do cash changes in cash flow statement. I'll tell you why. Okay. So here, what is the effect? Plus 150.
Plus 150.
Cash is the result of a cash flow statement.
Hmm. Hmm.
Understood? Because this is CFO, right?
Hmm.
Then you have CFI.
Hmm.
Then you have CFF, cash flow from financing.
Hmm.
So which is 0? Cash flow financing is also 0, no effect.
Zero.
Right now, there's no
Hmm.
activity.
Hmm.
So now what we will do is we'll say that, okay, at the start of this period, what was the cash? 0.
Zero.
What was the change in cash? So you will
150.
add these three.
Hmm.
So changes in all the activities, which is CFO plus CFI
Plus
plus
CFA.
CFF would be 150.
150.
So your ending cash would be plus 1.
150.
So this ideally in a balance sheet, that is how the preparation goes. You never calculate cash in the balance sheet. You calculate it through cash flow statement and then take this to the balance sheet and show it as cash.
Ah, okay.
Okay. So whenever you are looking at any years of balance sheet, for example, you are looking at 2023, 2024, 2025, right? And so on. And whenever you look at cash, specifically cash, I'm saying I'm not talking about marketable securities, nothing.
Hmm.
And you're also creating cash flow statement out here. So same years, but I'm going to categorize it as beginning cash and ending cash.
Hmm.
So for example, in 2023, you might have some beginning cash of 2022,
Hmm.
right? So this is 2022, sorry, 2000, 2000 and just give me a second. This is 2022 ending cash, which becomes the beginning cash for 2023. Okay. So ending cash is beginning cash of 2022 plus changes in CFO, CFI, CFF becomes the ending cash for 2000. Same thing for ending cash for 2023 becomes the beginning cash for.
2024. Yes.
So that is how it continues. So
Hmm.
all the data for cash flow, balance sheet for cash comes from always cash flow statement.
Okay.
Okay. So this is one example that we did.
Correct. But same will be applicable to the inventory details as well, right? Inventory entry.
Yeah. I mean, yeah, it doesn't matter. No, we already did inventory entry. No, see,
Mm-hmm.
we did it in parts.
No, no, I'm just saying that, like year on year when you're preparing the balance sheet,
Yeah.
so whatever was the closing entry of inventory,
Yeah.
for example,
Beginning
will
balance,
be carry
ending balance.
forwarded. Okay.
Absolutely.
Hmm.
In even for equipments.
Hmm.
So general format to follow is this. So beginning balance
Hmm.
plus changes. Okay, plus or minus changes.
Hmm.
Ending balance.
Hmm. And
You can
then
do
this
it
will
for
go up.
anything.
Hmm.
For example, if we could do it for equipments.
Hmm.
So beginning fixed assets, right?
Hmm.
We could say changes in the form of purchases,
Hmm.
which is also called as capex, right?
Hmm.
You could reduce the sale of equipments. and that would give you the ending equipments, fixed assets,
Okay.
right? Same
Hmm.
thing, you could also do it for retained earnings,
Hmm.
that equity. So beginning retained earnings, like last year's retained earnings, plus net income changes. What are the changes in retained earning? It is net income, right?
Hmm.
Minus dividends. These are the changes for beginning retained earnings, right?
Hmm.
And that would become ending retained earnings,
Okay.
right? So now let's
Just if you can just revisit those entries like assets and liabilities, we did a uh, entry for inventory, so that was previous year minus current year balance, right? If
inventory, since it's an asset last year minus this year.
okay,
Always, whether it's equipment also doesn't matter. That is
okay,
only to get the correct sign in cash flow statement. See, otherwise you'll have to think.
yeah, this was my only confusion that I asked in the beginning of the class.
You have to you can't always think,
Uh,
is it plus minus, right? So that simplifies that.
So this is for all the three statements: operations, investing, and financing, or how's
Yeah.
it?
Whichever section of the cash flow statement you want to do,
Hmm.
if it is relating to assets or liabilities, it will be done like this. Okay. It see, because generally think about this. When you're doing this, you're doing it in an Excel.
Hmm.
So in an Excel, you don't have time to to put plus and minus. All you could, and you have it in the horizontal statements, right?
Hmm.
You have, for example, you have 2022, 2023, like this, so on you have. So when you're linking and you're making the cash flow statement in another change, what do? You do last year, you link this cell and you will reduce it with this cell.
Hmm. Okay.
Yeah, it will be last year minus this. So it becomes simplified and you will never get it wrong,
Okay. Now this is clear.
right? Uh, in general terms, whenever we're talking about cash flow statement, when people are, especially in the colleges, when they try to, teach cash flow statement, they're always thinking, outflow, inflow, outflow, inflow.
Uh,
Very difficult. You will go crazy.
that is the confusion I'm carrying forward from my this one accounting subject that I studied in MBA.
Yeah, I know, I know. And this is exactly what I say in the class, that when people come to CFA,
Hmm.
whether people have background or don't have background, they've never learned financial statements in this way.
Yes.
And this basically creates that foundation for never having that doubt anymore,
Yeah. Now,
right?
now this is clear.
Exactly. Anyway, so what that was about the current assets, linkages between current assets and current liabilities.
Current liabilities.
Now let's look at some other example.
So the example, the Excel जो हमने किया था last week.
Yeah.
This is a good opportunity to understand the entries, right?
Yeah,
Again,
you
with
can
the same
do,
sheet.
when you redo it, it will be, now
Hmm.
it will be child's play,
Hmm. Okay.
because now you understood, right?
Hmm. Hmm. Hmm.
Why we are doing this. And now let's get into the main topic. Okay, which CFA wants us to understand,
Hmm.
which is the difference between direct method and indirect. Now this will become one again confusion for you all, is that what is this direct versus indirect? So what you made it in that sheet Excel
Hmm.
is indirect method. Whichever cash flow statement you see in the world, most of the
Hmm.
annual reports are all indirect methods. Why
Achha.
is it called an indirect method? Is because in indirect method, we start the cash flow by adjusting the net income, right? So we take net income from income statement,
Hmm.
and then we start adjusting. What do we adjust first? We add the non-cash expense like
Hmm.
depreciation.
Hmm.
Now remember the thing that I spoke about, gain,
Yeah.
unrealized gain.
Unrealized gain. So interest that we
So
were
you would have
getting.
to reduce that because that is added in net income.
Okay.
It is added, right?
Other earnings that we were talking about.
So minus gains unrealized. You you have to understand that if it is unrealized, you have to minus it. Okay. Then now you would do the changes. So plus and minus changes in balance sheet, current assets, and current liability accounts. Right? This you would do like inventory, accounts payable, accounts receivable. Then you would get CFO.
Hmm.
So related to this part is what the difference between direct and indirect is. Rest after CFI and CFF both are same. Okay. So what is different is in case of direct method, instead of starting from net income, we directly start from revenue.
Hmm.
How do we start from revenue? Is that we use the revenue. Okay, a company has said revenue is 100. Okay, now we need to adjust. So
Hmm.
what do we know that adjusting account is what? In case of revenue, we'll need data like cash paid by customers. Okay. Then, if in case we are talking about expenses, then we would need information like cash paid to suppliers and then arrive at that, CFO. The challenge is right now, I'm just giving a brief overview. Okay. The challenge is this data is never presented by companies. Okay.
Cash paid to suppliers.
हाँ ऐसा कुछ डेटा है ही नहीं मतलब why will company give you that data, right? And that is the reason why 98% of the companies presented the cash flow statement using the
Indirect
indirect
method.
method. At least I have not come across any companies till now, at least listed companies who would present it in direct method because
Hmm.
this is more hard work. Although you would be surprised to know that IFRS and GAAP make a statement stating that we allow indirect method, which is this one, but direct is encouraged.
Hmm.
But nobody is encouraged in reality.
So basically, like this is for more transparency, they're saying.
Yes, but then it also requires a lot of costs because to present all of this data in the manner in of direct method calculation requires a lot of compliance data. Right? Imagine, no, you will have to, instead of 5 people, right? And also plus you might give in secrets to your trade data to your
हाँ
competitor.
नहीं वो मतलब cost is very sensitive thing, right?
Yeah, why will you give, right?
Cost paid to suppliers, like okay, I have a different understanding, I have a different quote, you will have a different quote.
Exactly. So because right now, if you look at any of the income statement, when you look at cost of goods sold, is cost of goods sold, it might be related to so many things. It might include labor, it might include transportation cost in some cases,
Hmm.
right? It might be related to hundreds of different of products. But when you're talking about cash paid to suppliers, that's a very sensitive information to give, right?
Hmm.
So generally, I've not seen that happen. So now let's look at some examples of direct method.
So when we are talking about the revenue, we are just talking about whatever we earn from customers, right? Like
No, no, no.
whatever.
Revenue means directly just the way we accrual, including accrual. Whether we received the money, we didn't receive the cash, doesn't matter. The regular revenue in both the cases are same. Now the point is how do we adjust it, right? In case of the indirect method, we are not even looking at revenue, right? We are looking at net income. We're starting from net income and then we are adding depreciation changes
No,
and all.
in the direct method, when we are talking about this revenue,
Uh,
what is that?
revenue is revenue, regular revenue, no, in your income statement.
Okay.
So
Okay.
income statement, look at the income statement. No, what is the top line?
So this will include whether it is unearned, earned, cash, whatever is there, right?
That is income statement. Don't get confused. Okay, we are talking about creating a cash flow statement.
Hmm.
Income statement format has not changed. Income statement format is standard. Still,
Okay.
revenue minus cost of goods sold is equal to gross profit minus indirect expenses is equal to EBITDA. That
Hmm.
format is not going to change.
Okay.
The point is, how do we create the cash flow statement using income statement and balance sheet? right? So what is the direct method is saying is we will use revenue.
Hmm.
Instead of adjusting the net income, which we usually do, we're going to be adjusting the revenue. But the problem is with revenue, you need data like cash paid to customers and cash
Cash
paid.
paid to customers and cash paid to suppliers as an expense.
Now
Okay.
look at this example that I've said. Okay. And just give me 1 second. Okay. Did you get a chance to look at that data?
Just reading.
Yeah. So see what it says is the income statement for Acme reported revenue is 2 3. So I'll write down the data. So revenue is USD 23598.
Hmm.
The year 2018 calendar year end. Okay.
Hmm.
So now they've given us some data which is saying that if accounts receivable increase during the year, okay, on an accrual basis higher than the cash received from customers for accounts receivable increase. So see, now the balance sheet item that they're given is accounts receivable. And it says that AR has increased by USD 55,
Hmm.
right? So now cash received from customers. So now this is the part when we are starting to learn how to calculate using the direct method. Okay. So cash received from customers would be what? 23598 minus 55, right? Accounts receivables is increased. Remember, this is the change we are talking about. Change in accounts receivable. So if accounts receivable is increased year on year, that means what has happened? People have not given in terms of cash. At least USD 55 has not been received in cash. So from revenue, if I reduce this, I should get cash received from customers, which is how much? 44,23,543. This is one example. Okay. Let's do one more example. So this is what we need to learn now if you want to calculating using direct method. Okay. Let me give you one blue box question. Similar lines.
This is all from curriculum, what you're putting in chat.
Yeah, all. I don't do any other source. Second question, yeah. Okay. Were you able to do this?
Sir, it would be like uh, 50 plus. We can do it.
No, देखो ना, revenue what is given? Revenue is given as plus 50,
Yeah.
right? Total expense is 35 million. Look at the last question, what it says. How much cash did the company receive from customers? So when we are talking about customers, we are not related to expenses, right?
Yes.
So, but what is the account which directly relates to customers in the balance sheet?
Revenue.
No, no, no. Revenue say linked
It
balance
is
sheet
the
when
cash.
accounts receivable, no?
Accounts receivable
Yes.
is
Right. So it is given here accounts receivable has decreased.
decreased by 12.
That means when account receivable is generally decreased, it means that people have cleared their dues.
Yeah, we have got the payment.
They've got the payment more. So that means cash, total cash received from customers, whether now current customers or old customers.
Hmm.
Okay, is now what? 50
12.
plus 12,
50 plus 12.
right? 62 million. Think no, it is not always talking about when accounts receivable has reduced.
Hmm.
Does it mean that it is only for the current year?
No.
No, it can be also related to the previous year. You might say that, yeah, out of this 50 million, there might be people who might have not paid,
Yes. Revenue.
but that effect is already captured in accounts receivable. Changes in accounts receivable, isn't it? Understood? Understood or not understood?
Yes. Yes.
If not understood, please let me know.
They just got confused with that other
See, again,
expenses and all that.
see, again, if revenue, let's take another example. Let's make our own example, okay? Let's say we have a business of selling, let's say, tea. Okay. So let's say we have tea stall as a business, and each cup of tea is, let's say, 10 rupees. Now, remember, when we talk about revenue, it is not when cash is received, but when the service is rendered. And let's say I supply to 5 customers of mine, whether they are people who come in my shop or whether I'm sending it in their shop. So I got a revenue of 50. Okay. And this is, let's say, first year. And this is second year. Okay. Clear? Till here. Now, I say that 50% of the people did not pay in the first year. So it created an accounts receivables of what?
25.
25, right? Now I'm saying in the second year, we again sold 50 cups, like 50 rupees worth of tea, but accounts, the previous due got cleared.
Plus 25 in the revenue of the next year.
So, no, 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 not revenue. Revenue 50.
Okay.
Cash received from customers. There's a difference. See, we are not trying to calculate revenue here. We are trying to do direct method. Remember, we want to calculate cash received from customers. In this case, was how much in the first year?
25.
25. In the next year, it is how much? 75.
So,
Because the accounts receivable has reduced, I'm saying. This previous due got cleared. So this has become 0. So that means in your account, people came and gave you 25 rupees more, right? Are you getting it? And I'm saying out of this, there were no dues. People did not take credit for this. They paid you cash. So they paid you cash. So you got first this year ka 50 rupees. plus previous due got cleared. So that is 25. So total 75 you got, no? Cash received from customers. Understanding?
Yeah, this is clear. This is...
So this is what I mean.
So,
All the changes in receivables is already capturing all the effect.
and again, if in year two we have had some accounts receivable,
That
it
would
will
have
have been
got
subtracted.
captured. See, that
Hmm.
could have got captured. See, for example, if there was still accounts receivable of 10,
That was some new, like, if two of them did not pay. So minus 10. 75 minus 10 will be 65 then.
or you could also do it in a different way. You could say last year minus this year. So 25 minus 10,
So that's
right?
50.
So that is minus 15. So that is 15, sorry.
15.
So instead of adding 25, right, you would add 15,
Hmm.
right?
50 plus 65.
So
Okay.
15 plus 50.
Hmm.
So that effect is already getting captured, is what my point is,
Hmm.
right? So this, I mean, these are basically what we are doing is we are using different examples to understand the same concept, right? Again, there is an example of suppliers.
Hmm.
Now, instead of customers, look at this question. I put in chat box. Try to calculate that. Again, so reported cost of goods sold
Hmm.
is
100 million.
100 million. Okay. Total
96.
assets is increased, we don't care. Because cost of goods sold, total assets includes inventory, but we are talking about paid to suppliers. So whenever we are talking about paid to supplier, we are looking at what? We're looking at specific inventory, right?
Hmm.
Cost of goods sold is related to inventory.
Hmm.
So asset values are just there to confuse you. Okay. So inventory has declined minus 6 million. So the change has already been captured, remember. Okay. Total liabilities are increased by 45. Doesn't matter. We want specific accounts related to cost of goods sold, which is again
Payable is 2
accounts payable.
million.
Yeah. So that has decreased minus 2 million. Okay. Now think without even doing any calculation, you should understand that if accounts payable is reducing, accounts payable means it's a creditor. So this is an outflow, cash outflow, right? Because
Yes.
you're clearing your dues,
Hmm.
right? When inventory is reducing, it usually means when
Cash out.
will inventory reduce? When you'll sell it,
Hmm.
right? It can also happen why inventory has reduced. Can also happen that at the same year you bought the inventory, at the same year you sold. So that is why we are always looking at change. Changes capture everything. You don't have to really think about it manually, right? So now what they're asking is how much cash did we pay to the supplier? So 100 million. Okay. Uh, Now you do the calculation. I mean, I explained you the whole thing.
Sir, but 2 million should be in positive, na?
Why? Accounts payable is reduced, no?
Because 2 million it's payable, but
पेबल का मतलब क्या होता है?
पे कर रहा हूँ लोग सामने.
नहीं नहीं, क्रेडिटर को ना, जो
Hmm.
आपको सामान सप्लाई कर रहा है, लेट्स से लास्ट ईयर अपना 2025 2026, let's say your accounts payable was 2 million and this year it is 0. How did the creditor You are saying that the creditor to whom I owed, I clear the bills. How did I clear the bills?
सर मतलब वो गुड्स सोल्ड, मतलब गुड्स सोल्ड होने के बाद मतलब
कॉस्ट ऑफ गुड सोल्ड से मत लिंक करो अभी।
हाँ।
अभी मैं बस बोल रहा हूँ, ऑल आई एम सेइंग इज क्रेडिटर। बैलेंस शीट में क्रेडिटर का अकाउंट तो घट गया ना,
हम्म।
तो बिल क्लियर किया ना आपने। हाँ,
सो
अब पहली बात तो हम ये समझ लें कि व्हाट डोंट मिक्स अप अकाउंट्स। फर्स्ट जस्ट अंडरस्टैंड वेदर दिस इज क्रिएटिंग एन आउटफ्लो और नॉट,
यस,
राइट? नाउ think about the other aspect. Cost of goods sold 100 million, okay, which is already given here, right? And we are saying so 100, and I am saying that 2 million is cash outflow. That means why I'm adding plus, I hope you understood, because the cash, it's an expense.
ये फिर से उसमें ऐड हो रहा है ना,
नहीं
पेबल
ये
है।
ऐड क्यों हो रहा है बता, क्योंकि हम कॉस्ट ऑफ गुड सोल्ड कैलकुलेट कर रहे हैं।
यस।
इट्स एन एक्सपेंस,
हम्म।
राइट? और वी कैन डू इन अ डिफरेंट वे, वी कैन से -100 and -2, so that we are saying that it is 102, right? But do not understand, ये इसको मत, ये मत समझना कि मैं इसको कैश इनफ्लो बोल रहा हूँ। आई एम नॉट सेइंग दिस इज अ कैश इनफ्लो, ऑल आई एम इज एडिंग टू द एक्सपेंस,
हम्म।
okay? Again now, uh, what else is there? Less decrease in the inventory of 6 million. Now think about it, when we are decreasing, should we do minus or plus? So right now it is 102
प्लस।
as the expense, right?
हम्म। ये प्लस हो जाएगा ना।
Think.
दिस इज नॉट एन एक्सपेंस, ये तो मतलब वी आर गेटिंग द कैश, राइट?
Which one?
इन्वेंट्री जो 6 million
Change in inventory. We were talking about change in inventory.
ओके।
Everything is change, right? Look at the term which is saying, but accounts payable decreased by 2 million. So it's always talking about the balance sheet item.
टोटल एसेट्स इंक्रीज।
Acha. Now think about it.
इन्वेंटरीज डिक्रीज सर, बट पेमेंट मिला नहीं मिला ये तो हुआ ना।
नहीं नहीं नहीं, अरे पेमेंट तो रेवेन्यू से रिलेटेड है ना।
हाँ।
अपन क्या कैलकुलेट कर रहे हैं? कैश पे टू सप्लायर्स, ठीक है?
यस।
पेमेंट मिला नहीं मिला हमको क्या करना है उससे, वो तो हमने रेवेन्यू में देख लिया ना।
तो ये
कैश
नेगेटिव
कैश रिसीव फ्रॉम कस्टमर्स में हो चुका है।
है।
अभी हम बोल रहे हैं कैश पे टू सप्लायर,
हम्म।
है ना? तो कैश पे टू सप्लायर में हमने एक चीज पे तो अग्री कर दिया कि ये 100 है, प्लस हमने पिछला जो बिल है 2 मिलियन का वो क्लियर कर दिया, तो ये 102 तो हो गया। अब मेरे को आपसे एक क्वेश्चन है कि जब हम ये कॉस्ट ऑफ गुड सोल्ड कैलकुलेट कर रहे थे इनिशियल स्टेजेस में, है ना, तो हमने कब बोला था कि ये बैलेंस शीट से ये इन्वेंट्री, ये कॉस्ट ऑफ गुड सोल्ड कब आता है? जब सेलिंग होता है,
हम्म।
राइट? तो अगर ये सेलिंग हुआ है इसीलिए तो इन्वेंट्री कम हुआ है, और अगर कम हुआ है तो वो ऑलरेडी कॉस्ट ऑफ गुड सोल्ड में है,
अच्छा, दैट्स वो 6 million वाला कंपोनेंट, फिर वी डोंट नीड टू कंसीडर
तो
अगेन।
माइनस करना पड़ेगा ना।
हम्म।
आप समझ रहे हो? क्योंकि ये
हाँ,
कॉस्ट ऑफ
यस।
गुड सोल्ड आया ही क्यों? जब
करेक्ट।
जब अपन ने बेचा,
हम्म।
जब अपन ने बेचा इसीलिए इन्वेंट्री -6 हुआ।
हम्म।
तो अब ये डबल काउंटिंग हो जाएगा इधर,
हाँ, सो 102 से इसको माइनस करेंगे।
तो माइनस अपन 6 करेंगे, इधर 6 ही है ना,
हाँ।
तो कितना आ जाएगा ये?
should
98,
be 90
96,
96।
96 million।
हम्म।
Remember the triggers. If something is already there, cost of goods sold, and inventory is reduced,
हम्म।
it means that selling has happened. इन्वेंट्री से, अच्छा दूसरा एग्जांपल देता हूँ। मान के चलो आप टी स्टॉल के बिजनेस में अपन, ठीक है, तो टी स्टॉल के लिए मिल्क लगता है, और शुगर एंड टी लीव्स लेट से, ये आपने मिला के, है ना, 10 kg लेट से ले ली। लेट से यू टुक 10 kg, ओके, एंड यू पुट इट। नाउ यू टेल मी इन द इनकम स्टेटमेंट, लेट से आपने अभी तक एक भी टी बेचा नहीं है,
हम्म।
तो रेवेन्यू जीरो है।
करेक्ट।
तो अभी क्या मैं कॉस्ट ऑफ गुड सोल्ड क्या डालूं?
नहीं, इसमें क्यों आएगा फिर?
एग्जैक्टली अभी ऑब्वियस लग रहा है ना, क्योंकि बेचा ही नहीं है भाई, तो उसका कॉस्ट क्या लूं?
हम्म।
जीरो है ना। मतलब आप खुद सोचो ना, मैंने बेचा ही नहीं है और मैंने 10 kg का इधर कॉस्ट ले लिया। लेकिन इनकम स्टेटमेंट तो क्या बता रहा था कि ये साल में कितना रेवेन्यू आया
हम्म।
और उसका रिलेटेड एक्सपेंस कितना है। इनकम स्टेटमेंट इज नॉट टेलिंग यू दैट अच्छा ये साल में रेवेन्यू कितना आया और भाई बाकी भी कितना खर्चा किया।
हाँ, इनकम स्टेटमेंट इज नॉट टॉकिंग अबाउट ईयर, किस साल में आया, करेक्ट।
हाँ ये साल में आके आपने भर दिया ना, तो
हाँ हाँ
आओ
हाँ।
बैलेंस शीट में डाल दो एज एन इन्वेंट्री,
हम्म।
एज 10 kg ऑफ whatever। अब नेक्स्ट ईयर जब आप बेचेंगे और आपने लेट से इसका 5 kg का सामान बेच दिया, है ना,
हम्म।
तो और उसकी वजह से आपको 100 रुपये आ गया,
हम्म।
तो इसका जो
ये
पांच
रेवेन्यू है,
केजी
देन
वाला
देन यू
पार्ट है,
हैव
फिफ्टी
कॉग्स, यस।
परसेंट
हम्म।
उसका सीओजीएस आएगा।
करेक्ट।
ये अभी भी इधर ही रहेगा, मतलब बाकी का 5 kg तो फिर भी रहेगा ही ना।
हाँ,
सनत समझ में आ गया?
ये जो इन्वेंट्री वाला 5 kg इधर रहेगा, वो कॉग्स में इधर आ जाएगा 5 kg का, करेक्ट।
करेक्ट। अब ये क्वेश्चन के हिसाब से वो क्या बोल रहा था कि देखो क्या बोलते हैं, टोटल एसेट, सॉरी इन्वेंट्री है, माइनस हो गया 5।
हाँ, तो
ठीक है,
102 से इन्वेंट्री माइनस 496।
इन्वेंट्री अगर -5 हो गया तो ये तो ऑलरेडी सीओजीएस के इफेक्ट में ऑलरेडी है ही ना, 100 मिलियन के।
हम्म।
नहीं तो कैसे सीओजीएस कैलकुलेट ही कैसे हुआ? सीओजीएस कॉस्ट ऑफ गुड सोल्ड, या जो 5 kg का जो कैलकुलेशन है इधर, इधर अगर मैं बोल रहा हूँ कि ये 50 है, और अलग से आपको मैंने इंफॉर्मेशन दिया कि देखो 50 का ना इन्वेंट्री घट गया, इसका क्या कुछ लॉजिक ही नहीं है ना। कॉस्ट ऑफ गुड सोल्ड में तो ये इफेक्ट ऑलरेडी है।
हम्म।
तो अगर ये ऑलरेडी इफेक्ट है, तो मैं इसको डबल अगर काउंट कर दूं अलग से, कि ये भी अलग से खर्चा हुआ, तो डबल काउंटिंग हो जाएगा, इसलिए हमने
हम्म।
उसका इफेक्ट निकाल दिया है। ठीक है, तो कॉस्ट ऑफ गुड सोल्ड 100 मिलियन लेस 6 मिलियन का जो कॉस्ट, जो अपन बोल रहे हैं कि चेंज इन 6 मिलियन ही था ना
हम्म।
इन्वेंट्री, हाँ डिक्लाइन बाय 6 मिलियन, एंड अकाउंट्स पेबल इंक्रीज्ड बाय 2 मिलियन, सॉरी डिक्रीज इन 2 मिलियन, मतलब वो उसका एडिशनल अपने को खर्चा है। क्लियर है ये?
यस।
और एक एग्जांपल करना है ये।
यस।
तो इसमें टोटल फिर व्हाट इज द टोटल आंसर ऑफ दिस वन, लास्ट वन? कैश पेड टू कस्टमर,
96 मिलियन ना अपन ने निकाला ना अभी,
पेड टू, दिस इज पेड टू सप्लायर्स, राइट?
सप्लायर्स, हाँ।
हाँ।
96 मिलियन ना अभी किया ना इससे पहले, हंड्रेड
अच्छा,
एट
दैट इज, हाँ दैट इज आंसर, ओके।
दैट इज द आंसर। ओके, चलो एक और एग्जांपल है। दिस इज नॉट रिलेटेड टू कॉस्ट ऑफ गुड सोल्ड, बट दिस इज रिलेटेड टू ऑपरेटिंग एक्सपेंस।
अच्छा।
हाँ ये देखो, इधर क्या बोला गया है कि रिपोर्टेड अदर ऑपरेटिंग एक्सपेंस, रिमेंबर व्हाट इज अदर ऑपरेटिंग एक्सपेंस? रेवेन्यू माइनस कॉस्ट ऑफ गुड सोल्ड,
हम्म।
ग्रॉस प्रॉफिट। ठीक है, फिर माइनस है आपके अदर एक्सपेंस। दिस अदर एक्सपेंस कैन इंक्लूड मार्केटिंग, सैलरी, वेजेस, एक्सेट्रा। तो ये अदर ऑपरेटिंग एक्सपेंस की बात चल रही है इधर।
Two components. Other operating expense.
हाँ, तो प्रीपेड इंश्योरेंस एक्सपेंस, प्रीपेड इंश्योरेंस इज एक्सपेंस बोला है, इंक्रीज बाय USD 4 मिलियन। तो प्रीपेड इंश्योरेंस इज जनरली एसेट, प्रीपेड है ना, पहले
हम्म।
एडवांस रेंट जैसा होगा, है ना। एंड एक्रूड यूटिलिटीज पेबल, दिस कुड मीन इलेक्ट्रिसिटी,
हम्म।
डिक्रीज्ड बाय 7 मिलियन। तो
अच्छा।
ड्यू क्लियर किया आप, है ना। इलेक्ट्रिसिटी ड्यू होगा आपके पास, वो 7 मिलियन से कम हो गया है
सर
बैलेंस।
तो उसको पॉजिटिव मिलेगी ना?
पॉजिटिव, पॉजिटिव इन द सेंस एक्सपेंस के तौर पे
हम्म।
आपका कैश आउट ज्यादा, एक्सपेंस मतलब कैश आप ज्यादा पे कर रहे हो ना।
हम्म।
देखो
ड्यू
यूटिलिटी,
पे कर रहे हैं सर वो।
हाँ रुको ना, इलेक्ट्रिसिटी बिल मान के बोलता हूँ, मैं बोलता हूँ ये, इसको अगर थोड़ा अपन इंटरप्रेट करके बोलते हैं तो वी कैन से दैट, अगर मैं ऐसा बोलूं कि इलेक्ट्रिसिटी बिल पेएबल हैज reduced टू, टू बोल रहा है, हाँ बाय, सॉरी बाय 7 मिलियन, वेयर इन द बैलेंस शीट। अब इसका मतलब क्या होगा, देखो
डिक्रीज।
इलेक्ट्रिसिटी पेएबल रिड्यूस्ड बाय सेवन
तो
मिलियन
कैश
बैलेंस
इसमें
शीट,
जाएगा ना, लाइक वी आर पेइंग इट आउट।
ज्यादा हो गया ना खर्चा, मतलब ड्यू
हाँ
क्लियर
एल,
किया ना आपने।
हाँ ड्यू क्लियर किया, यस, तो
हाँ,
कैश विल गो डाउन, राइट।
हाँ कैश विल गो डाउन ऑफ कोर्स, कैश
हम्म।
आउटफ्लो, बट इन टोटल एक्सपेंस इट इज प्लस।
हाँ, टोटल एक्सपेंसेस प्लस।
हाँ अभी देखो दूसरा क्या बोल रहा है, प्रीपेड एक्सपेंस नहीं, अच्छा एक मिनट, प्रीपेड एक्सपेंस इंक्रीज्ड बाय USD 4 मिलियन, एसेट बढ़
हाँ,
रहा है,
तो एसेट बढ़ रहा है, यस।
तो ये भी आउटफ्लो ही हो गया।
प्लस में।
प्रीपेड इंश्योरेंस और
हम्म।
बढ़ गया,
हाँ, तो कैश आउटफ्लो अगेन।
तो +4 मिलियन,
हम्म।
है ना। और कुछ है क्या?
नहीं,
अच्छा नहीं
30
नहीं, पूछ रहा
मिलियन।
है ना टोटल अदर ऑपरेटिंग एक्सपेंस इन कैश कितना है। तो
हम्म।
एग्जिस्टिंग रिपोर्टेड रिपोर्टेड अदर एक्सपेंसेस इन द इनकम स्टेटमेंट, रिपोर्टेड ऑपरेटिंग एक्सपेंस इन इनकम स्टेटमेंट इज हाउ मच, 30। तो
हम्म।
ये आंसर आएगा 41, बरोबर।
यस।
30 प्लस 7
और यस।
प्लस 4, है ना। अब उल्टे तरीके से देख सकते हैं, अगर हम इसको मॉडिफाई करके सोचना चाहते हैं, इफ यू वांट टू थिंक, व्हाट इफ ऑपरेटिंग एक्सपेंसेस 30 मिलियन ओनली, but prepaid in expense had reduced, right? Instead of plus, if it was minus,
प्रोड्यूस हो जाएगा।
मतलब कैश आउटफ्लो नहीं हुआ इसकी वजह से, माइनस अगर हो गया तो, और एक्रूड लाइबिलिटीज बढ़ गई। लेट से इलेक्ट्रिसिटी बिल जो है ये जो घटनी, इस बार तो हमने ड्यू क्लियर किया ना, लेकिन लेट से अपना ड्यू बढ़ गया, तो कैश आउटफ्लो कम हुआ, करेक्ट। तो 30 - 7, ठीक है, -4, उल्टा, उल्टा भी सोच लिया करो ताकि यू नो इट विल बी क्लियर व्हाट एग्जैक्टली आर डूइंग। क्योंकि अदर ऑपरेटिंग एक्सपेंसेस तो बोला था 30 मिलियन है, लेकिन ड्यू बढ़ गया, इसका मतलब मैंने कैश नहीं भरा, तो मैंने कैश नहीं भरा, नो कैश, राइट। और प्रीपेड एक्सपेंस, दूसरा प्रीपेड एक्सपेंस ही है ना, प्रीपेड एक्सपेंस लेट से घट गया, रेड्यूस्ड, मतलब मैंने खर्चा ही नहीं किया, इनफैक्ट मेरा जो पुराना प्रीपेड इंश्योरेंस है वही
हम्म।
घटे बैलेंस शीट में, तो उसकी वजह से मेरा कैश आउट, मैंने कुछ कैश आउटफ्लो हुआ ही नहीं बेसिकली, है ना।
सर इंश्योरेंस का मतलब मतलब प्रीपेड इंश्योरेंस का तो पॉजिटिव होगा बराबर, और इंश्योरेंस का ड्यू होना मतलब नेगेटिव, राइट?
नहीं, डिक्रीज और इंक्रीज पे है ना। देखो एक्सपेंस नहीं बोल रहा हूं मैं, आप अच्छे से
हाँ,
देखो,
ये
वो
इंश्योरेंस प्रीमियम इंक्रीज
बैलेंस,
बाय।
हाँ
इंक्रीज
बैलेंस शीट की बात चल रही है, ये जो दो आइटम है ना,
हम्म।
ये बैलेंस शीट आइटम की बात चल रही है, और ये जो है ये इनकम स्टेटमेंट आइटम की बात चल रही है।
अच्छा।
तो ये जो 7 ड्यू है, ये बैलेंस
हम्म।
शीट में ईयर ऑन ईयर जो चेंज देखा, तो ड्यू घटा है या तो बढ़ा है, और प्रीपेड इंश्योरेंस के केस में भी घटा है या बढ़ा है बैलेंस शीट में। तो उससे हम निकाल रहे हैं कि कैश पेड टू, लेट्स से फॉर ऑपरेटिंग एक्सपेंसेस कितना था। तो पहले केस में आपने क्या बोला कि देखो प्रीपेड अदर ऑपरेटिंग एक्सपेंसेस 30 मिलियन था, ठीक है, और बैलेंस शीट में प्रीपेड इंश्योरेंस एक्सपेंस 4 मिलियन से ये साल बढ़ गया है ईयर ऑन ईयर,
हम्म।
और पेबल डिक्रीज हो गया है 7 मिलियन से, तो 30 मिलियन का तो खर्चा है ही, ठीक है।
हम्म।
मैं बोल रहा हूँ कि एक्चुअल कैश में कितना खर्चा हुआ है ऑपरेटिंग एक्सपेंसेस में, अदर ऑपरेटिंग एक्सपेंस में, तो मैं बोल रहा हूँ 30 तो है ही,
30,
लेकिन देखो
यस।
पहले का ड्यू भी क्लियर किया, तो 30
हम्म।
+ 7 37,
हम्म।
और प्रीपेड एक्सपेंस और बढ़ गया, मतलब अपन ने
और
और
बोल।
ले लिया है,
हाँ,
तो प्लस
तो वो
4,
4 और +4 और होगा।
तो ज्यादा खर्चा हो गया ना।
हम्म।
So this is cash paid for operation. So you can also look at other examples, which I don't think so right now in the class is required to be done. Is cash paid for income tax and cash pay for interest also. This is just to you to get an idea of direct method calculation. Okay. In the next class, what we will do is we'll continue with the indirect method. The next part is indirect method only.
डायरेक्ट वाला ज्यादा कंफ्यूजिंग है।
बहुत कंफ्यूजिंग है। हाँ, क्योंकि इनडायरेक्ट कैसा ना, सिंपल है, लास्ट ईयर मैंने दिस ईयर मैंने लास्ट ईयर
हाँ।
फिनिश्ड। इसमें सोचते रहना पड़ता है ये आउटफ्लो है या इनफ्लो है,
हम्म।
और साइंस मैच नहीं होते, देखो।
हाँ, साइन साइन का ही वो चक्कर है ना। बिकॉज
हाँ,
जो
तो
एंट्री
जब
भी
कैश
करते हैं
आउटफ्लो
कैश
हो
फ्लो
रहा है,
स्टेटमेंट में।
जब कैश आउटफ्लो हो रहा है तो अपन ऐड कर रहे हैं,
हाँ,
जबकि नॉर्मल कैश फ्लो स्टेटमेंट में अपन कैश आउटफ्लो में ऑटोमेटिकली माइनस आ जाता है।
इसमें भी अनदर थिंग इज कि आप कस्टमर को दे रहे हो तो साइन विल चेंज,
हाँ,
सप्लायर को दे रहे हो साइन विल चेंज।
एग्जैक्टली, तो दैट इज द रीजन व्हाई आई डोंट अंडरस्टैंड व्हाई दिस टॉपिक इज स्टिल देयर, बिकॉज इट इज नॉट
वो भी
प्रैक्टिस।
तो होना चाहिए ना कि पास रेट जो मेंटेन करना है 40 to 45%।
वो भी
उसके
बात
लिए
सही,
भी है ना ये।
वो भी बात सही है ना।
तो फिर वो एग्जाम का वैल्यू क्या रह जाएगा।
तो आप ना प्लीज अभी आप लोग वो एक तो एंड ऑफ चैप्टर वापस 3, क्योंकि अभी थोड़ा सा हम आगे चले गए हैं।
हाँ, नहीं नहीं ना नाउ लाइक अभी जो स्पीड अप हो रहा है। सो।
हाँ, तो स्पीड अप और होगा तो, और ना क्या ना, कैचअप इन टर्म्स ऑफ प्रैक्टिस थोड़ा डिफिकल्ट हो जाता है। तो
हम्म।
माय सजेशन इज कि एटलीस्ट अभी तक इनकम एनालिसिस ऑफ इनकम स्टेटमेंट, सॉरी, इंट्रोडक्शन टू फाइनेंशियल स्टेटमेंट्स, इनकम स्टेटमेंट, बैलेंस शीट,
हम्म।
लिस्ट और कैश फ्लो का जितना अपना हुआ है उस
हम्म।
क्वेश्चंस कर लो आप,
ओके। ठीक।
जितने हो सकते हैं, और श्वेजर के भी जो मैंने आपको दिए हैं वो भी कर लो।
हम्म।
तो एटलीस्ट, क्योंकि अभी नेक्स्ट वीक से कॉन्ट भी चालू हो जाएगा आपका
अच्छा।
पैरेलली संडे को, तो फिर आप थोड़ा सा स्पीड बढ़ जाएगा, आप आपको कैचअप कैचअप नहीं करना है तो फिर आप पैरेलली चालू कर दो।
ओके।
क्वेश्चन क्वेश्चन प्रैक्टिस करते रहो, 5 क्वेश्चन तो हर रोज करो, कोई
हम्म।
दिक्कत नहीं है। और फिर जैसे ही एफएसए कंप्लीट होने वाला होगा, बिफोर दैट वी विल हैव अ सब्जेक्ट टेस्ट। ओके,
अच्छा।
सो
ओके।
व्हाट वी विल डू इज, एफएसए कंप्लीट हो गया, एफएसए का सब्जेक्ट टेस्ट, क्वांट हो गया, तो क्वांट प्लस एफएसए का सब्जेक्ट टेस्ट मिला के,
हम्म।
ठीक है। तो दैट इज हाउ वी विल कंटिन्यू एंड दैट इज द वे टू क्लियर द एग्जाम।
ठीक।
ओके, चलो गाइस,
साउंड्स गुड, साउंड्स गुड। ओके।
बाय।